And we're off. Oh, look at that jump. There we go. All right, let me turn this music off here real quick. We're getting pumped today. Got to get that aggressive music going because we've got an aggressive plan coming up. So it's finally almost time. Got to throw that almost in there. We've got the Fed coming up on the 21st. That's next Wednesday, not this one coming up. That's the big event that we've been waiting for a while. At least I've been waiting for a while. We have to see what the markets are going to think about it. This jump up is a little interesting to me. I was thinking that the market was going to be a little bit more bearish leading into that, although we could have some pops going up to the meeting, which is pretty normal. There's usually a little bit of volatility, but I'm expecting some downward movement because people don't know what the Fed's going to do at that meeting. See, that's the important part right now. The Fed's kind of let off everything. It's been all about economic data. It's been all about earnings for the past month and a half, almost 2 months. We had that meeting in July where they raised rates by 75 basis points for the second time, which is a lot. See, that's one thing we don't realize right now. Like a lot of us that are newer to the markets, or we haven't really seen what increases used to be like. Right now, they're really intense because we have an extreme inflation problem. We haven't had inflation this bad in a long time, probably in a lot of our lifetimes. I don't know if it's worse than it was in the 70s and 80s. I don't necessarily think so, but it's close. It's around that level, and we're struggling right now. That's why the Fed has to really, really pump things up. And we've kind of switched from, is the Fed going to do enough, to the Fed's going to crash the market. That's what the thinking is right now. Everything I see is the Fed's going to overcorrect, which I think is likely. I mean, these things are really slow. It's like you're trying to create waves, but you have to see where the waves go and where they break before you can adjust how you're going to make more. Actually, that's not really a true statement because it takes too long to do those things. You might have to adjust first while the waves are still going, so you don't really see exactly where you're going until after you've done it. And if you overcorrect, it's going to take time to bring things back. It's not instantaneous. And that's what a lot of people aren't looking at right now, is the fact that these moves are slow. They're very, very slow. We're just now seeing the effects of everything we've done this year. I mean, these rate increases are extreme. If you go back, you don't see very many double 75 basis point rate hikes. Not to mention, we might have another one. See, that's the expectation right now. Some people are thinking 50. If data comes in low enough, it could be 50, but it's looking like 75 again. I mean, I'm still up in the air for the decision on that. I really don't know if it's going to be 75 or 50. The last couple of rate hikes, I've had a pretty good idea by the time the meeting rolls around, and we still have a week and a half, so we'll see what happens. We also have important data coming out. We have the CPI. That's the next thing we're looking for. Like before the meeting, the CPI comes out, I believe, on Tuesday the 13th. Is that right? Yeah. So it's CPI is coming out on Tuesday the 13th, which is this Tuesday. The expectation is that it's going to be 8.5% for the headline CPI and 5.9% for the core. Now, that's important because that's in line with what we had last time. Last month's CPI reading was around 8.5, 8.6, somewhere in there. It was in the middle. It was lower than it was the previous time because the previous CPI was like 9 point something. And it went down to the 8s from there. If it stays in the 8s, that wouldn't be surprising because it's going to take a little while for things to go down. Not to mention, this is comparing to a year ago. So prices are probably going to be somewhat in line with what they were in the previous month. Although, we'll just have to see. Some prices have really come down. I mean, gas has come down. Food has come down. We've seen a lot of stuff coming in. Hey, Sloan Fishby rating, what's up? How's it going? Thanks for the raid. Appreciate that. Hey, Sloan Fishby and I did a nice little fun podcast the other day where he taught me how to play Splinterlands. I'm still really new and learning, but at least I have the basics and I'm kind of practicing right now. We're going to try to get another one of those streams in coming up pretty soon. Not sure when that's going to happen, but we definitely want to do it as soon as we can because it was so much fun. And I'm getting into Splinterlands. It's like before I knew that I was going to want to do it, but now I'm actually kind of liking it. And it's a way to earn money while you play. I think that's the future, right? We've kind of gone pay to play in the past, I don't know, 10-ish, 15-ish years. Companies have realized, we can make a lot of money if we do that. However, I think the incentive is going to go play to earn, because why would you keep sinking money into something that's not going to mean anything, right? Like there are these games where it's so easy to just drop a bunch of money, drop 50, 100, 200, 300 bucks into a game in the matter of a day or two, and what does he get you? I mean, you get some little power-ups or whatever, but then they're gone. So that's why I like play to earn. I think it's a lot better. I think it's going to be what people gravitate towards as they realize, hey, why am I spending money on this stupid game I don't care about? Why don't I earn money on some other stupid game I don't care about? That's better, right? Yeah, if you're going to be entertained, you're going to play anyway. You might as well get something from it. So that's what I'm thinking. All right, so back to what we were talking about. We had a nice futures open here. Let me get this off the screen because we don't really need that anymore. We're taking a look at the futures. The E-minis are up quite a bit, not extreme or anything, but that's a nice little jump. I mean, when you have a level change like that and it makes all the other candles look like a tiny flat line, that's a pretty good jump. So we had some orders, a lot of market orders sitting in wait for this. That's why these gaps happen. People put in a couple of different types of orders, and one of them is called a market order, which is buy it for me at any price. That's what it means. And it stacks up in a queue because there's a trading time, and it can only be exercised during that time. So the futures open at 3 p.m. Pacific time on Sunday. So if you've got orders sitting in there from Friday night, Saturday night, whatever it is, they all stack up. And eventually, if they're saying fill me at any price, the market just goes whoop right up on top of them. It uses them as support to get up there. And look at that. We're climbing a little bit too. So there's a little bit of optimism, but actually, I don't think it's optimism. I think it's more people adjusting their positions, getting out of things. We've had quite a bit of downward movement, and we just started a little uptrend, so it could be continuation of that. I'm not really sure. All right, so let's take a look at the futures and get back to everything I wanted to talk about because there's a lot to talk about this week. We have a lot of preparation. The E-minis are up. The NASDAQ is up. The Dow is up. Bitcoin's been climbing up, so it's up there at 21, so that's really nice. It's actually been down in the teens. It's kind of been climbing for the past, I would say, week or so. How long is this? No, maybe just a few days. Okay, it's only been climbing since like Thursday, Friday. It's probably following the action of the market since it's so closely tied. ETH is kind of in the same thing. It's been going up, not quite as straight as Bitcoin is, but at the same time, it's still up, which is nice. And I think people are trading ETH a little heavier than they used to because people are realizing, oh, ETH has a lot of value. I mean, Bitcoin's a currency, but ETH can do so many different things. That blockchain has so many other cryptos on it that are doing all these different things. So more and more people are trading ETH. And I also think people are a little scared because we have the merge coming up next week. At least I think it should be next week. The Ethereum Merge is going to be switching from a proof of work system to a proof of stake system. Now, part of that is because of the energy expenditure of crypto, which is really difficult. Hey, how's it going? Do you use volume profile? Yes, I do. I'm going to get to that in a second here. Let me actually finish this out. So crude didn't really move. Interesting. Bonds, they're not really moving. And we've seen everything else. So let me close this out, get back over here. If you want to take a look at the volume profile, which is actually what I'm going to do with the support and resistance here for what's coming up in the markets. So this would be the SPY on the weekly charts. Here's the look at the year right now. We've had this drop. We kind of had a bounce after the last meeting. It doesn't look like a long time, but this is actually quite a while. This is a few months worth of movement. And we've had quite a bit of upward movement before we hit this recent down. And we're bouncing, right? So is this bounce real, or are we going to keep that? Do I trade futures or just the ETF? No, I don't trade futures. I just watch them to see what's going on. I trade options on stocks for the most part. Also a little bit of crypto, and then own some long stock too. But the futures are a good indicator of what might happen. Not always, because the volume's thin on the weekends. But I still like to watch them just to see what happens. It's kind of a way to get going. The daily will show you where that rally started because it was kind of in the middle of the week there. Any reason for not trading futures, just what you're into or not? I just like trading options on stocks because I know them a little bit better. It's also, I like the risk a little bit better because I don't want to be paying so much for futures contracts. Yes, I know there are cheaper futures contracts out there, but I don't know. I like the rules of options. I'm used to options, and I like specific stocks. It's a little bit harder for me to trade trends on the actual indexes. Are you trading futures, and what are you trading those futures on? So mostly I'm just trying to see what I want to do for the week because what I'm focused on right now is the Fed. Right. I mean, I want to see what the market does before the Fed, and I'm going to wait for an opportunity. I'm actually going into a little bit more cash because every Fed meeting that we've had so far, I've had an opportunity to day trade, which I don't normally do. I'm usually a swing trader. So let's see. What'd you say here? I'm trying to do this index futures on Tradeovate. I don't know the Tradeovate platform, but I'll have to check that out one of these days. I'm actually using Thinkorswim here. Let's see. Why do people like SPY so much? Well, SPY is just well known. It's not so much that it's great. It's just that it's kind of one of the original ETFs. It's the one, it's the one that gives you the best overall idea of the market because futures are limited on who trades them, but the SPY is wide open for a lot of people. There are tons of people that would trade futures but don't understand them, and they trade the SPY. So to me, it's a little bit better look at the actual market itself, at what traders are doing in the now. The whole reason that I brought this up is because we have this Fed meeting coming up, and that's the important thing, right? We've been waiting for data for the past couple of months, and we got most of that. We still have the next CPI, which is Tuesday, and that's going to affect my decision on what I think the Fed's going to do. And it's going to affect a lot of people's decision on what the Fed's going to do. You're still learning. Okay, good. That's interesting that you're starting with futures though when you're still learning, because to me that seems a little bit more complicated than just starting with stocks. What is the meeting? The Fed meeting. It's the FOMC meeting on September 21st. It's when the Federal Reserve is going to decide what the next interest rate increase is going to be. That's the huge event in the market that we're waiting for right now. It's if you're not watching the Fed meetings, you really should, because that's what's driving everything right now. Let me back up so I can show you the actual year. There's the trading action for the year. Each one of these bounces coincides with a Federal Reserve meeting. This is why I want to watch it, because if you're wondering, oh, we had this downward drop and a pop, why is that? Well, because the first Fed meeting came in right here. They raised interest rates 25 basis points, and everything was in line with what the market thought. So the market is trying to price in what they think the Fed is going to do, which is why this meeting is so important. I mean, you can look at individual stocks, you can look at what's going on in the news, but the big thing that matters is the Federal Reserve right now. Like, you really, really have to pay attention to that, because that's what's going to move the markets every time. Fed meeting right here, boom, pop right after it. I traded this, but on very few shares. I actually traded the Qs and just got a few shares of it. Dumped it up here. I didn't even hold it for the rest of this right here. But then we had this drop due to earnings. Companies were reporting and it was okay, but they were guiding down. And that's the other thing you have to think about, guidance. So the three most important things right now would be, number one, the Fed. Number two, how companies are guiding. Number three, what analysts are saying about those companies. So that's what happened here. We pumped up after the Fed because there was a short squeeze. People were betting against the Fed. The reason this happens every time is because people are way, way more bearish than they need to be. So they overcorrect to the bottom and they get squeezed out, right? But then reality sets in, and during this drop, companies were reporting earnings and going, hey, our earnings up to now have been good, but we foresee the future not being as good. And that's what company after company after company said, which is why we went down, down, down right here. And then when you get down here to the bottom, we had yet another Fed meeting and a pop, which is the exact same thing. People saw this huge drop, got super bearish, and got squeezed out when the Fed reported and said, hey, we're still in line with everything. So we had another drop, and then guess what happened down here? The Fed, yet again, it pumped it again. So this is why I'm watching it. It's every single one of these big pumps right here, and these are weekly candles, so these are longer-term trends. I'm not a day trader. I'm a longer-term swing trader for the most part, even though I've made a couple of day trades recently. But that's telling you right there, the Fed is the most important thing that's going on in the markets right now. So let me see what you said. You started trading crypto a little bit, but New York requires brokers to have an extensive crypto license and limits which platforms you can use. Yes. See, I was actually talking about some of the New York rules a while ago. Like when they implemented the rule on stable coins, there's a lot more verification that has to happen now with those. I can't remember exactly what the news was, but I know New York is being extremely harsh with crypto right now. Part of it's political, and part of it's because crypto is a little bit damaging to the environment. It's expensive to run. You know, it's got some issues, right? So it's not like nothing should happen on crypto, but New York is definitely tough on it. So I can see why you're moving into other things right there. Yeah, it's pretty long term, still useful info. The New York rules are awful. Yeah, I've heard a lot of complaints. I really need to look into them more, but I'm on the other side of the United States. I'm in California, so we've got our own set of interesting rules going on over here, but it's kind of in other areas. But right now, my big focus is just save up cash for this Fed meeting, right? Here's my expectation. And I don't know if this is actually going to happen. You have to take everything I say with a grain of salt. In fact, you have to take everything everyone says with a grain of salt, because nobody actually knows. People that say they know are either lying or they don't understand what they're saying. Anything could happen. But if I'm looking at past performance, it's likely that there could be a squeeze after the Fed. Now, that depends on what they say. Okay, so that's the key thing right here. You can just watch these meetings and not know what's going on, but what you need to know about the Fed is, what is the market expecting? If the market's expecting the Fed to do something and they do it, the bears will get squeezed out, right? If the market's expecting something and the Fed says, hey, things are worse than we thought, that could tank the market. So you have to pay attention to what the Fed says. You can't just be like, oh, the Fed meeting, I'm going to catch it. I mean, maybe you will, but maybe not. So every one of these pops right here, I day traded because the Fed said they were in line with what the market expected. That's what we're looking for. Are they in line with market expectations? If they are, boom, mini rally. How long is that rally going to last? I don't know. I mean, we've had this trend going down for a while that hasn't broken until now. So we have a little bit of a break in the trend, but it's come back down a little bit. And this could either be a bounce before the continuation, if you're listening to people like Michael Burry and all the bears that think it's all over right now, which is a possibility, or this could just be the beginning of the uptrend. Because the thing about these uptrends is it comes before you expect it every single time. Now, I consider myself an intermediate trader. I've been trading for about 5 years, and it seems like every time there's a bear market, it goes by so quickly that you don't recognize the bull market until it's too late, and then you're chasing it. So what people are thinking is it's going to be more bearish than it is, and then the market goes up. So right now, is this a continuation of the down move and we just had a nice squeeze of everything? Or is this the start of an uptrend, which it very well could be? Because if you go back in time, you see these things look like V's. They don't usually hang out at their lows for a while. And the market knows that everything is okay systemically. See, that's the other thing too. Like in 2008, we had systemic problems that could have crashed the entire financial system, not just the stock market, which is a small piece of the whole thing. We had systemic problems. This time, we don't. So I think the bears are overly bearish and they're going to get squeezed at some point. But is it now or is it later? Because we have two more events, or we have two more Fed meetings coming up, and we have a chance at a good tax loss selling year. So that's the other thing I was going to talk about today is tax loss selling. We're in our first down year in a long time. Are we going to end the year down? I don't know, but I think the odds are good because we've been down for so long. So many people's positions are getting crushed. They want to get out of them. And this is a chance to sell those for a tax loss gain, right? And if you don't know what that is, every year traders will reposition themselves. And a lot of times they'll take their losing positions at the very end of the year if it looks like it's not coming back, and they'll sell it off so that when they report on their taxes that they have these other winners, they can offset the taxes they're going to have to pay on those winners. So it's actually kind of a good thing for them. And when it's a down year, people are way more likely to think about it. And that's because I've been waiting for another good tax loss year for a while. And every single December, it doesn't happen. But we have our first down year here. If it holds, then I think it could. So I'm waiting for that. So what else we got here? You're going on for the scalpy trades and the fees, 8 profits? Yeah, exactly. I could see it going either way. Yeah. See, it's hard to tell. I mean, that's kind of what everybody's thinking. Well, actually, not everybody. A lot of people are sure. But, I mean, your uncertainty is right there with mine. I feel the exact same way. I don't know if it could go up or down. I don't think it's going to go down as far as the Bears do. Like, I think the Bears are extremely wrong, to be honest with you. And the bulls, they're kind of hard to find right now. There aren't too many of them, but people are lying in wait. Institutions are ready to buy. They know that when all this stuff clears, when all the risk has been taken out of the market and everything finds its little bottom price, then it can pump again. And it may have already started for all we know. If the Fed comes out and says, hey, things are actually going well, then we'll see. But that CPI number that's coming up on Tuesday will be big. So we have to see what that says. There's going to be a ton of economic data between now and the Fed meeting. So any of that could be factored into their decision. But for now, we're looking at that CPI number and the Fed. That's what I want to do. So I talked about CPI. We've also got retail sales numbers. That's going to be coming out on Thursday. We're going to see what retail sales are doing. We're going to see what CPI is. We've got the FOMC meeting, and we've got the Ethereum merge from proof of work to proof of stake. Those are the things that are coming up this week. So the main points I wanted to talk about, we've had kind of a drop in the past couple of weeks, right? So now that we've said that the Fed is the driver of everything, and the economic data leading up to that is what the Fed is going to be looking at, as well as the market's reaction to that data. So if the data, here's the other bad thing: if the data goes down, if CPI goes down, which is positive for inflation, the market could rally. And then the Fed will be like, oh, the market's rallying. That means we haven't tamped down prices hard enough. There's still too much money floating around. So that could be a bearish sign if things take off right after that CPI number. Now, if they take off for a day or two and then come back down, that's no big deal. That's usually just the bears getting squeezed and people getting excited, whatever. But if there's a serious rally, like from Tuesday all the way leading up into the Fed meeting, that could be a problem. So we got to watch for that too. But on the technical side, we're in this area of low resistance coming into high resistance, right? This is why I like the volume profile, because it tells you where a lot of the different shares changed hands, where the big volume is. So a lot of people are long in this range, right? So they're actually all underwater. Most people that own the SPY, or pretty much any of these instruments, because they're going to have the same profile. They all kind of trade in line with each other. Most people are underwater because they're in this range, this like 4,100 to 4,400 or 500 range. And we're sitting here below 4,100. So all these people underwater, a lot of them want to sell. They're thinking, I've been, it came up, I bought in right here at the top because I'm dumb, and then it all came down and I'm underwater yet again. Because these people were buying these dips thinking it's going to come back soon, right? Or people were buying it more likely last year when everything was going up and they were chasing it. All the money was just following it until the Fed announced, hey, guess what? We're going to stop this. This is getting out of control. We need to bring things down. That's what this was right here. And this is why I love the chart, because you can actually tell the history of a country or the world by the chart, right? We've had this extreme stimulus and easy money coming into the markets until the Fed said, hey, it's time to start talking about how we stop this rally. So the market went, oh, crap, all right, we can't go any higher. They finished off the year a little bit higher and then dumped because of the fear, right? So then finally we have that first meeting. They say, okay, things are all right. We're going to raise it a little bit. Don't worry. Boom, get that pop. Companies are saying, hey, I don't know what earnings are going to be. Well, that's scary. Get the next meeting. Everything's in line. We're going to do what we said we're going to do. Pop. Companies doing the same thing. I don't know what's going to happen, blah, blah, blah. We got to get out of this. And then we have, yet again, everything's in line. We're gonna. It's the same story 3 times in a row. Pop. And now we're up a little bit higher. We've got a little support down here if we come back down, and we're getting into resistance. So my prediction is that it's going to hit a little bit of a top right here if the rally continues a little bit. As soon as we start getting up into this like 50-day move, is this the 50 or the 100? As soon as we get up into like the 100-day moving average, and I'm using simple moving averages, and this heavy volume area, that's where it's going to be tough. So I could see a rally going up another, let's see, where are we at right now? We're at 406. I can see we could go up to somewhere around like 415, 420-ish before we get rejected. Maybe a little higher than that, but you got to remember this area right here is extremely thick. It's like going through thick weeds, going through thick forest. You're not going to be able to travel quite as fast. However, people want to get out. So that's resistance to the upside. People want to get out because they're afraid of everything. They think I lost all this money. I gotta go now. Normally, what you would want to do is hold. You never want to get out when you're down, especially when you're buying into a product like the SPY that's following the market. I mean, look at the performance of the SPY over the lifetime of the instrument. Like, why are you getting out of this thing, right? How often do we get these dips and chances to buy? Not very often. And when we do get these dips, nobody wants to buy because they think the market's going to keep going down forever and they're scared, right? And then it starts to rally because the buyers are starting to come in with a bunch of capital and buy up all the stuff that nobody wants anymore at a really cheap price. So that pushes things up really quickly. And eventually people go, oh, rally's happening. And they start chasing it. But that's when we get the volatility. That's when we get these dips right here. Also, we had stuff like this was the 2015 election. Right? See, the market was going up pretty well until the 2016 election, I should say. I think it started in 2015 because that's when you lead up to everything. And then once the election was over, here it was a 2016, somewhere around here. Then once the election was over, boom, the market took off because that pressure was relieved. And we have another election coming up. Now, this isn't a presidential election, but it's a midterm election, but it is important. And this is where policies are going to change, right? Because people are going to run on platforms of, oh, I'm going to support this, I'm going to start that. And those things that are connected to stocks in the market will rally on that. Or because things are going to stop, people lose their seat, and then the programs that they were funding go out, and new stuff comes in. So there's going to be some capitulation. There's going to be some change. And if you're in something that's pumped by the politicians, then you could get a nice little pump off of that. I'm in something that I don't think is going to do very well because we've already had most of the gas like ripped out of it. It's basically, I have a cannabis play. I was hoping for some people to run on the cannabis platform because really it's popular with most Americans at this point. And if you're in a struggling politician and you need something to jump on that'll get you votes for people that wouldn't normally vote for you, that's it. But that has not done very well because we've got that bill that's probably not going to pass because they never do. It's a super long bill, which means all kinds of stuff has been added into it, earmarked to oblivion. So it's probably not going to get passed. But if it does, I'm going to make a good amount of money. I'm long shares in ETFs of cannabis, so it's going to be a while, and it's been crushed, which is what I like. I like to get into things when they've been absolutely destroyed. I don't like playing these little jumps here and there. Like you were talking about day trading and stuff like that. I tried that when I first started, but it just doesn't work very well for me. I have so many problems with it, so I don't worry about it too much. I tried it. I got out of it. Now I'm looking at the long-term trends, which is why I'm here on this weekly chart and why I'm using this volume profile on the weekly chart, because it's showing me what could happen. So what I'm looking to do right now is I'm looking to trim my positions, right? So since I'm talking about getting ready for this Fed meeting, what I mean is I want some cash ready and I want some long positions ready. But I think there's going to be a little bit of downside before we get there because we still have a week and a half. And we're having this rally a little bit early. It's like in sports when a team starts doing really well a little too early and then they get tired at the end. That's what I'm thinking might happen with this rally. Where if it continues on Monday and goes for a few days, maybe the rest of the week, that's good. But at some point, people are going to be like, all right, we got the Fed coming up. We need to get out of things just in case everything goes to crap. Which it could. If the Fed comes out and says, hey, things are terrible, then the market could crash. So in this rally, I'm looking to shave off whatever long positions I'm not that confident in. Like I had all these little trades on. I got rid of a bunch of them at a loss just because they weren't doing it for me. I mean, I mostly do like a few big trades a year. That's what I save most of my capital for. But every so often I do these piddly little like for fun trades basically. And it's a good way to lose money and kill some time while you're waiting for the actual trades, which is why I don't like over trading, you know? Like you want to get a number of occurrences. You want to make sure you're trading enough to learn, but at the same time you don't want to trade so much that you're losing all your capital on these stupid little trades. So these little ones I keep super small, and they're mostly just because I think it might happen, and I'm getting antsy. You know, it's hard to hold on to your money for a while when you're just watching things go up, and you go, man, I could have been in on that. I could have been in on that. Well, you weren't researching it, you weren't following it, so don't kick yourself for that. It happens. There's gonna be all kinds of stuff that goes to the moon and back, and you're gonna miss it. So just concentrate on the things you know and follow them until you get your opportunity, which is what I'm doing. And everything I know is not ready right now. So what I'm trying to do, like I said, shave off some of my stuff so I have as much cash as possible. I still want to stay long because I feel like there's going to be a bounce after this. So I don't want to get rid of all my long positions, and I might add to them as we go down, assuming we do. But if the Fed goes the other direction, if things actually continue to go down, you know, I've had this long exposure. I'm probably going to trade to the upside. I'm going to make sure that I have some kind of downward protection. So I'm looking into hedging at some point. I don't know what I'm going to do yet, but I'm going to try to get it this week. I'm hoping if we get a rally, I can get some hedges to the downside just to cover a little bit of the money on the way there to the Fed. And I might let most of them up before the meeting, but keep a couple on just in case. And I'm not really sure what I'm going to do yet. So what do you got here? The margin for a mini is only $500, so I'm going to try that, I think. Oh yeah, you're using margin. Like I don't see, that's the other thing. I don't use margin either. I'm all about small gains, not a very big account. I'm just trying to make little nibbles here and there. I had some problems going. I used a bunch of my money on an investment that could have made me a whole bunch of money. It was the first time I'd put that much of my money into one thing, and I got absolutely ruined. So I decided to not let myself trade with all that much money. No margin, small account, until I feel confident enough to put a lot more money into something, which is going to be a while. So I'm more just building things up. I'm making these little trades, taking the winnings from it, and putting into my long portfolio. Let's see. Was it a startup? What are you talking to start? Oh, yeah. No, it wasn't a startup. It was actually a long-established company that was going to merge. It was a card company that was going to get a deal with the MLB to make a whole bunch of cards, and it didn't end up going through. Another company bought into or got the deal right at the last second, like right before the vote to take the thing public. It was absolutely ridiculous, and I lost a ton of money. You know, it was heartbreaking. And I'd been trading for a while at this point, so it frustrated me to the point where I gave up. And when I came back, I decided to say, all right, I'm going to let myself come back, but I'm going to keep it small just because I don't want to go through this again. I know it's going to hinder my gains and it's going to take a lot longer to progress, but that's okay. I'd rather do whatever keeps me in the game long enough. Because eventually you might be in a trade that goes to the moon. I mean, that's the lucky guess is like one day you get into something that just randomly goes up like crazy. And the only way you're going to do that is if, number one, you trade in a way that keeps you in the game so you don't lose all your money. And number two, you continue to trade so you have the option to actually do that. You have the chance, the probability. You have to be in something for that win to actually happen. So you can't be scared to get in things, right? There's a happy medium, and that's kind of what I'm looking for. And that's what I talk about here, right? There's a lot of people that day trade. There's a lot of people that talk about risky stuff. I'm basically combining trades and long portfolios into one thing to make it easier, because if you're trading, you can make gains going either direction. But if you have a long portfolio, you need the stock market to go up, or at least you need your investments to go up. So when it's going down like it has this year, a good way to hedge against that long portfolio is to trade, which is why I do that. It's diversification of not only investments, diversification of strategies. And that's what I'm trying to do right now. I'm trying to diversify enough to make money no matter what the stock market does. And that's why you say, why do I trade options? Because that's what I like about options. I mean, I know you can do the same thing with futures, but you can trade options with smaller amounts. You can watch the companies a little better. And the people that trade futures just know way too much. They know more than I'll ever know. It's like competing against people you're not going to win against, right? So I'd rather be in the retail market in these stocks that everybody's trading, from people that know what they're doing all the way to people that have never traded a stock before and are just buying something because it looks cool, right? I want to be with those people because I can take advantage of their stupid moves or their good moves. All you want to do is ride that wave. You're not trying to start the wave. You're not trying to get in on something that gets the moon. Just keep going. That's what I'm trying to do here. So it says, yeah, options seem like a good way for more guaranteed profits. Guaranteed that's a harsh word, That's a difficult word for me to use in trading because, nothing is guaranteed. But if you look at the odds of trading, like if you sell options, you're more likely to make money. It's going to be a higher risk, lower reward, but your win rate's going to be much higher because most options expire worthless. The same with futures. I mean, people that are selling the futures contracts are the ones making the money. I mean, that's why the markets move the way they do, is because people buy calls in huge amounts, and then the people that sell the calls have to buy the stock to hedge their bets, right? They don't buy enough to cancel out their gains, but they buy enough to move the market sometimes, which is also why I like to pay attention to contract cycles, because when they change, things can move. Let's see. Yeah, it's a bit of an extreme word. Yeah, I mean, with investing, yeah, that's just the one thing. Like, I don't like absolutes. I'm very. I guess you could call me wishy-washy if you want, but I really like to just make sure that what I'm doing is confirmed. Right? If you're trading in the moment, it's really hard to actually see what you're doing. But if you're trading over a long period of time, and you don't have to make a trade right now, you can make a trade as the moment comes, and you're not under pressure. That's what I like, because I really want to sleep well at night. I don't want to be worrying about my money like I did when I was day trading or while I was putting a whole bunch of money into stuff. So now it's okay. I lose a couple of trades, no big deal. I'm not using enough for that to really hurt me. And when I do go bigger on the trades, yes, it sucks, but I'm not blowing up. No matter what, I partition my money out and make sure that if I blow up the trading part of the money, I still have the long money and I still have the cash. Because those are all positions. Like cash is a position, long stock is a position, leaps, long-term option contracts, those are a position. I'm using those to invest in a few different things. Like when the market's down, I really like leaps because people lose faith in it and they become cheap. And then when the market starts to go up, everybody wants them, and you've already got them, so you're not chasing the market up. That's what and you want time, because options and futures, they expire in a set amount of time. So if you have a lot of time, theta, or the decay on those options, isn't going to kill you. That's what I'm looking at when things go really low. Look at some leaps, look at some long stock, and then maybe some shorter term options if I want to catch a jump, but that really depends upon what's going on. So I think this happened before the last broadcast, but Powell gave a speech at the Jackson Hole meeting. He's the head of the Federal Reserve. He basically scared the markets and let everybody know that the Fed's going to be more hawkish, meaning they're more likely to pump rates up. And they basically said, we're okay bringing things up too high. We're okay with crushing the labor market. See, that's the thing we're talking about. Are people going to lose jobs? Yeah, they're going to. There's not really a way around it. But how many people are going to lose jobs? How bad is this going to be? I mean, we're at next to historic low unemployment right now. But before the pandemic, we were really low, and we're to that level or maybe even lower. Actually, I think we've come up a little bit since the last one, but employment is extremely low if you look at it historically. So if it goes up 1% or 2%, it would be going more towards the mean. Right now, it's below the mean. So we're going to see what happens with all that. I think that is going to scare people, because if people are getting laid off, that means companies don't need them to work on the stuff, which means they're not selling as much stuff. So their profits are going to drop, and that's why the stocks go down, because investors anticipate that. They go, oh, they're laying people off. That's positive in the sense that they're not going to have to pay as much, so they'll have a little bit more money on their books. But the reason they're letting them off is because they don't expect to sell as much stuff, which means their profits will go down anyway. So the safe bet for the traders is just get out now. But if the Fed comes in and gives the all clear sign, it could bounce, and that's what I'm waiting for. I don't know if it's definitely going to bounce, but that's what I want to know. And that Jackson Hole speech scared traders, which is good. I want the market to drop. The more downward action we have before September 21st, the better, in my opinion. Right? Sideways is okay. A slight trend up is I don't know if I like that as much, but that would tell me that people aren't really afraid of what's going on. And if the market drops enough, then the Federal Reserve will come out and be like, okay, I think it's good. You've had enough pain. We're going to let things go. So yeah, the Jackson Hole speech scared everybody, and the market's likely going to trade sideways until the Fed meeting. The other thing I saw was Fed President Waller said the recession fear has faded. We have a robust labor market, and it allows us to be more aggressive with rates. So he basically said, we're okay slamming rates up too high also. So it's not just Powell. Powell said it. Some of the other Fed presidents said it. Esther George, one of the other Fed presidents, said peak policy rate is speculation. Sustained policy rate is required. That basically means people that think the rate hikes have peaked are speculating. The Fed thinks that this is going to have to last for a while. And that's what we're going to see bringing down the markets over time. So these big rallies we've had in the past 2 years, we're not going to see those quite as much. We'll see volatility, but because Interest rates are going up. Money is more expensive. Quantitative tightening is now coming into effect. There's going to be more supply of bonds, which is going to drive prices down, hopefully. There's so much downward pressure on the market that I think if whatever rally we get after the Fed would be crushed, which is why I'm also looking to the end of the year, right? 2 more Fed meetings where they could say whatever they want. They could jack rates up, pause it, whatever, and tax loss selling. So we have a lot of bearish stuff coming up, which is why people that say, oh, we're going to have all-time highs. In fact, I remember somebody coming on in like May or June and saying it was going to be all-time highs by August. Well, we passed August, and what happened? That was like the lowest part of the drop right there was August. So you never really know, right? You always got to take what people say with a grain of salt. Life of Ronan, what's up? How's it going? You want to check out a fun gaming stream? Check out Life of Ronan. He's usually streaming a couple of nights a week. I think, what is it, Monday, Wednesday, Friday, something like that. Yeah, come in, hang out with him. He talks to you. He's a cool dude. I really enjoy being on his streams. Thanks for coming by, Ronan. I appreciate it. So, next thing on the list, the ECB, the European Central Bank, they hiked rates as well. 75 basis points, which for them is even higher. They barely move in Europe. They keep things a lot lower than we do in America. America's really extreme. You know, we like to do everything like crazy, including our rate hikes. But the European Central Bank does not usually do that. So that's a sign that we've got some downward pressure in many markets, right? Because these markets are all tied together. Yes, the United States market is pretty much the biggest stock market, but you got to think like Europe has its own little section, Asia has its section. There are so many different markets that all tie in together and affect each other. And the U.S. market is tied in through everything: South America, Africa, Europe, you name it. They're all tied in together. Watching their rate hikes is important as well. So here's the other thing that I saw. Now, this kind of makes me think that there could be a bounce, right? This is the interesting thing. I saw that traders are getting more bearish. Last week, the puts beat calls by 8x. There was like $8 billion worth of puts bought on the S&P 500, the general market, maybe the Dow, maybe the NASDAQ, whatever it was. It was 8 times the rate of calls. So people expect the market to drop. Right? That doesn't mean it's definitely going to, but because people are expecting it, I think we're going to get a little bit of a drop, but that also tells me that a squeeze is way more likely. And that's what we're looking for, a short squeeze. We want the market to drop continuously, at least if you're following what I'm doing. I mean, other people have other strategies, but for me, I want the market to drop. I want this to go down. I want people to get super, super bearish. I want to see these puts go up and up and up. I want to see short shares go up and up and up so that when the Fed comes out, if they go, hey, everything's in line, those people are going to have to cover, and it's going to explode because the bulls are waiting, the shorts are getting overconfident, and we're getting to the point of the year where it's do or die right now. Like, if we don't get a rally that sustains anytime soon, this year is done, which is great. I want that. I want tax loss selling. I want a chance to up my long portfolio. I want to be ready for 2023 because we're starting to get to the point where we have to think about that. We still have 2 Fed meetings. We still have 1 more earnings cycle, and we still have the end of the year tax loss selling thing. So we got to get through that, but start thinking about next year because that's when things should be turning around. That's when the Fed's expecting to start lowering rates or at least pausing. That's when the market's thinking profits are going to go back up again. Shipping has been slowly resolving itself, so that's picking up. Inflation hopefully will continue to come down. So 2023 is important. That was the last point. It's a down year. It's an election year. That's the other thing. Remember, we have the elections, so there's going to be tons of volatility until that's over. So we could start seeing a rally right after November. Like the middle or beginning of November, you might see the rally start if the market is worried about elections. If Powell comes out and says, hey, we're cool, if inflation comes out and it's in line or lower, and if the election goes by without too much craziness, then the market might start rallying then. I'm hoping for the end of the year, that complete, like the very end of the year, but we might start getting it early in November. So that's another thing to watch for. All right, so let me get into some stocks here. I made a few trades, and there are a couple of trades I almost made but didn't, which actually would be the first one. Let's go here to DocuSign, DOCU. Now, this one right here, I knew was going to pop. If you're thinking, oh, how do you know something's going to pop like that? Well, this is the pattern that I look for. I want a stock that's beaten up, has a high short interest, and is in a sector that is necessary. Now, DocuSign is for like signing documents at home and doing a few other electronic, I forget the terms of it, but they're basically verifying things for you, and they're signing documents, which you need. The more people at home doing things and working, the more you're going to need to sign for things, the more you're going to need authenticity. So they, to me, are in an important sector. Their financials aren't the greatest, but they're not terrible either if you think about newer companies. I mean, sometimes these companies have ridiculous amounts of debt. DocuSign's not so bad in that category, and they've been beat up like crazy. Look, every single earnings meeting has been destroyed, right? So these dots right here are the earnings reports and the conference calls, which after they report earnings, they always say that, hey, Juice Gorilla, how's it going? Good to have you in the stream. That's what I'm hoping for, man. I want people to get that knowledge that keeps them empowered for their own finances. Like, I grew up in a place where people just weren't into talking about finance, you know, and I think that's a shame. I think if you learn finance when you're young, I think, man, if I just bought a few shares of like Apple, right? If I just bought a few shares of Apple when I was like 10 years old or something, or just sometime in the 90s, those few shares would be worth tens of thousands of dollars right now. I could have put like $50 in Apple as a kid and just left it, never touched it. That would seriously be worth like 20, 30 grand or something ridiculous because they've had so many splits. I mean, maybe that's a little extreme, but if I just put my money into something, Amazon when it was like $2, right? I could have even bought Microsoft after it had already run up because it has continued to run up. I mean, there's just so many things that you could do that are safe. In fact, just buying into like a mutual fund, an index fund, right? That's following the market in general and has people with degrees managing everything for you. You could just throw down some money in that as a kid, not have to worry about trades at all, and that would be worth more by now. You know, so I think learning about finance when you're young is important. In fact, they should do more of it in schools, which is why I started getting into it, and I just wanted to talk about it with people. Hopefully people can learn from what I'm doing, learn from my mistakes, learn from whatever I do that's right, and make their own decisions, do their own research, learn how to do their own research. And that's what I'm doing here. So getting back to the stock here, DocuSign, every single earnings report has been a drop, right? They disappointed at the end of 2022, and everyone since then, drop. So I thought, okay, that's good. They've been beaten down. And the other thing I like about them is, let me come over here and grab this and bring this on screen, is their short interest, right? So here, I usually use Yahoo Finance to find out what the short interest is. And this is still the same data that I saw before their earnings report. So 8 to 9% of their float is short. And the float is the amount of shares available for trading for people like you and me, right? There's the entire shares outstanding, which some of that is owned by the insiders, some of that is locked up for like options and warrants, you know, assuming that the board of directors does something well, maybe they get a bonus in those shares. So some of that stuff is locked up. It's with institutional investors. But what's left over for everybody else to trade is the float. And the float for DocuSign is just under 200 million. And the shares short are about 17, 18 million. So a good chunk of that is short. So I thought, all right, 8% is a good short interest. It's not the greatest. I like to see double-digit short interests, but it's close to that. So it's been beaten up forever. It's got a high short interest, which means people are way too bearish on it. It's got earnings coming up, and it's probably going to do okay, right? All they have to do is say, hey, we're relatively in line with what you thought, and the stock is going to pop. So I don't know if that always happens, but in this case, I was looking at that and I knew that might actually happen. Hey, Plabs, how's it going? Hey, man, I've been listening for a while and I don't know much about what's being talked about, but I still find it interesting. Thank you. I appreciate that. Yeah, just that's the best way to do it. Just immerse yourself in finance. If you don't know anything, just listen to it, right? It's okay because you don't know it now, but you're going to pick up on things as time goes on. You're going to learn more and more. That's what I did. That's how I learned. I didn't go to school for this. I just decided one day that I wanted to try it. I started watching TV, YouTube videos, social media, whatever. And after a while, I just started to pick up the lingo. You know, when people say a good way to learn a language is to immerse yourself in it, I totally agree because you slowly pick it up over time. And eventually you're looking at things that you would have thought you never even would know about. So that's what I'm trying to do here is get this stuff going. So back to the DocuSign thing. We have a good short interest. They have earnings coming up. So I knew this thing was going to pop, right? And the options were also extremely cheap. So I was looking at calls. Well, actually not extremely cheap. The options are expensive, but relative to the puts, the calls were expensive. Were cheap. So I thought there's some ground to be gained here. And I almost did it. I was looking at it in these days right here when it was low, but I thought, man, each one of these contracts is just so expensive for the time that I want to get in on it that I don't think I want to risk it just in case it goes down. Well, look what happened. Boom, it exploded. I could have made a good amount on that. In fact, if the rally continues, DocuSign will follow it. So this was a good pick for me. I should have put it in the Discord, but I didn't. I'm always afraid of putting my picks in there in case they don't do well. So, but this was one that I thought, oh, this is a good one. If you have the money for this, or because I'm trying to save cash. Like if you have the money for this would have been a great play to make. So DocuSign was a good one. They beat earnings. Everybody, all the shorts got squeezed. Then they got analyst upgrades. In fact, what do I have written down about it? So the EPS came in at 44 cents. The estimates were 42, so they beat that. The revenue came in at 622 million. The estimates were 600, so they beat that. That means they took in more money and they made more money with that than they were expected to, which is why things went so well for DocuSign. So that's the really bullish when you get a company that reports better than expected, and then they say, hey, in the future, we expect to make more than we thought and you thought. That will pump them up, which that will also usually cause analysts who sit there and just write articles about stocks all day. It'll cause them to go, oh, look at this. They're doing better. I'm going to write a positive article, which then gets other people to buy in. The more time goes by, the more people are going to get into a move. So you'll see like a small amount of people get into the move right away, and then the masses come in later. And that's who the analysts are talking to. They're saying, hey, look at this. They did well. You know, the people that aren't watching the earnings, the people that don't know as much about stocks and just kind of look at it casually, that's who the analysts are talking to. Also, they're talking to all the institutions to say, this is what our feeling is, which means institutions are probably going to get behind that and move the stock, which will cause traders to get in there. And that's why these pumps right here on earnings are so big, because they'll beat the numbers and they'll guide up, and the traders will instantly pop it up, right? And this is usually algorithms and stuff. You can't really trade as fast as this thing blows up. But as things settle and people figure out what it is, there's profit taking, and you get another chance to start to get in before the masses figure this out in the next few days. Right, because this is old news to me. This happened on Thursday, and I saw it, and I'm just like, okay, I'm done. That was an event. I could have played it, but I didn't. But there are people that are going to come in on Monday and see that their DocuSign shares are up, and then there's an analyst upgrade saying, hey, they're going to make more. That's going to cause people to buy more if the market is moving up. If it's not, then that's going to be bearish for everything. The market is going, like rising tide lifts all boats is exactly what's going on right now. You can't really judge the movement of any individual entity because of the movement of the entire market. So this could continue up if that goes. So that was my pick last week. I thought, all right, this looks good. I guarantee this, or I don't guarantee, right? We're saying we don't talk about guarantee, but I was pretty sure that this was going to happen. I thought this was a very high odds play, and it was. So that's why I like that. Beat up stock, good sector, decent company, high short interest, and earnings coming up that could be a surprise. Because the other thing is earnings have been better. All year, companies keep saying, oh, we did well this quarter, but next quarter is not going to be so good. And they keep doing fine. Yeah, it's a little bit less than it was before, but they're still doing better than they expected to do for the most part, which is another reason why I thought this was going to pump. Because companies are doing well. Business is continuing. Unemployment is low. Spending is high. We're still getting money moving through the markets, which means the systemic risk is not there. It's all fear in our heads right now. There could be problems. Systemic risk could show up. There could be something we don't know about yet. But everything we're seeing right now is all fear-based. It's not because these things are actually bad. So this was a good pickup. I've also still been buying things long because I'm expecting a bounce at some point, and I'm okay with the pain. We could go down for another year, and I'm good with that. We can go down for another 2 years, and I'm good with that. I don't think it's going to last that long, but this is longer than most people are expecting. So a lot of the new participants in the market, they're getting crushed or they're already out. So they'll come back in as soon as things start to look good again, and they'll help lift us up. So that's what I want to be in. I want to take the pain so that when everything starts rising, I'm not the one chasing. I'm the one just riding the tide, and I'm happy, right? Everyone else is trying to trade and get in there because they missed that first move. I got to get the second move, the third move, the fourth move. We'll just take it all. That's the thing here. Get ready for it. We like pain. We're masochists. This hurts, and that's good. Let's do it. Yeah. Okay. Got a little bit too pumped there. So let's move on to the next trade. The next thing I did was Kroger's, right? So kind of a similar situation. I saw this one coming up. I thought, okay, grocery chains have been doing well. Food, people need food, right? That's one of the most important things. Commodity prices have been high, but they're coming down. There's a chance to make more in profits for stores like this again. So there's a good chance that they go up after earnings. And well, what do you know? Boom, pop after earnings. Part of that was because the market went, but that's what the earnings said. People were going, all right, if the market lifts, is it okay to buy Kroger? These results said yes. It's okay to buy Kroger if the market goes up. So it did. And if the market continues, Kroger's going to go with it. So part of me is hoping we get a few days of a rally. So these options that I have on Kroger's, because that is the one that I actually bought, Instead of buying DocuSign, which would have been a better play, I bought Kroger's, which I thought wasn't going to go well at first. I mean, if you look at this, it's very red in the morning. I thought, oh, well, here we go. All the volatility's been sucked out of the contract, so they're basically worthless again. They're about half of what I paid for them. But as the day went on, they started to come back, and it went to new highs, well, for the recent trend, I should say. And those contracts are looking much better. So if we get a drop, then those contracts are going to get crushed again, and I'm going to be sad about that. But it's not a huge trade, so whatever. Like I said, I'm working on the Fed. Let's see. I like the hype. Yeah. Hey, that's what I do. I'm trying to hype everybody up. Everyone's so scared. Everyone's so sad. They watch too much news, right? It's like the financial media and the mainstream media in general, all they do is talk about how we're all going to die and everybody's fighting each other and the world is terrible. But you know what it is? It's rare. All right. Anything you see on the news, anything you see on these shows is rare. It's not the common thing. That's why it's interesting. If it was common, it wouldn't be on there. So all the stuff that you're seeing that makes you think, oh, the world's going to be over and everybody's at war with each other. No, they're not. On the internet, there's a bunch of people at war with each other because they're venting off steam and they're incels or whatever, or they're just in their basement and they're mad at the world. Yeah, there's those people. But the rest of us, like if you go out in the world and talk to people, people are not saying all this stuff. People are not fighting with each other. They're okay. Like if there are disagreements, they work through them. Most people are more reasonable than we think. We don't give people enough credit. We think, oh, we're smart, but everyone else is dumb and blah, blah, blah. No, we're dumb too. Everybody's dumb. You're dumb. I'm dumb. The people are dumb, and that's okay. We're all on the same level. Even like the people, the elites, the smart, or they're supposed to be smart, they're dumb too. In fact, they're dumber because they think they can't be fooled because they're so smart. So it's good to be around a bunch of people that aren't like that and like, okay, I understand what I am and everything's okay with that. We're just going to work with the world. We're not going to fight about it. So a lot of people actually are cool and the world is not going to be over. And the whole point of this is to say, we're going to be fine. If you panic like everyone else does, you're going to lose money and you're going to have problems. You're going to be very anxious. You're going to feel terrible about the world. No, don't do that. Just be on the side of everything's going to be okay. Because and it will. It's like a self-fulfilling prophecy. If everybody thinks the world's going to crap, then the world's going to go to crap. If people think it's going to be okay, then it's going to be okay. So I'm just using my brain power to make things okay, right? That's what we all should be doing. Ignoring all the stupid stuff in the media that makes us fight and just being friends with each other. It's that simple. So everyone is dumb, but we can learn together. Yeah, everyone's dumb. Everyone's smart. People are smarter than you think. They're also dumber than you think, right? It's just a whole, the universe is massive, man. You can't just make any absolute predictions on anything. So just roll with the tide and look at history. Here's my favorite thing. So before we move on real quick, I want to go back to this. I say this a lot, but let's go to the SPX so we can see the history of the market for the past 100 years. And let me switch this to let's do a yearly chart. Okay, so here's the market over the past almost 100 years. Okay, like you don't have to know anything about stocks to know, wow, that goes up. It continues to go up. It has not stopped going up the entire time, right? Here's the Great Depression and all this stuff. It's down here in the bottom. You can't even see it anymore. If you got out of the market in the Great Depression, assuming you were still alive, which I mean, you'd be pretty old at this point. But if you got out of the market, you missed out on all of this, man. There were so many people that left in that Great Depression era because it was terrible. I mean, it's like a 3, 4 year, 5 year bear market followed by a short rally and then another 3, 4, 5 year bear market. I mean, that'll destroy your psyche. That's like what happened to the .com crash and the housing crash. I mean, people never came back from this because it was so extreme. But the whole reason I'm showing you this chart is to show you that every time people have said the world is going to end, it never ends, right? Look at here. The low was $4 on the SPX, right? The S&P 500, that's a measure of like roughly 500 of the biggest companies in the United States and somewhat in the world as well. It was $4 in the 30s, right? Right at the bottom of the Great Depression. You could have bought, it's $4,000 right now. That's 1,000x. So you think about how many end of the world predictions have happened during this time. Like look at the 30s, people thought it was over. World War II, you think people weren't bearish during World War II when the nukes were first invented? People were terrified. That was extreme at that time. But look what happened. It went up. We didn't blow ourselves up because what do you know? We're actually a species that survives. Regardless of what you think about people, the species itself is around for a reason, right? Because there are some of us that will do the right thing in those tough times. When things really go to crap, there are people that step up and get us through it. That's why our species is here and why all these other hominids that we find aren't. Because we outcompeted them. We did the right thing when shit got tough. And that's what we always do. So when people say, oh, the world's going to end, this is it, it's this time, blah, blah, blah. No, you're dumb, all right? That's when people are being dumb. It's never, ever been right. Not once. 100 years plus, it has never, ever been right. So look at this as an opportunity. Look at how much of a pump we've had since 2008, right? Here's the end of the great financial crisis right here. Massive pump. Now, we need to have some correction because of that, because that's extreme compared to what has happened in the market before. But look at that. I mean, this is an opportunity. The world is not over. You don't get these opportunities very often. When things are going up, all you can think about is, man, I wish there was a dip. I wish I could get in at a better price. I wish I had it at the SPY at 250 and it's 400 now. Like, that's what you're always going to think. So when you get these dips, instead of thinking the world's over, get ready to buy. Take the pain. We're masochists. Let's do this. We're tough, right? You got to take a punch so you can throw a punch. That's what we're doing. We're taking punches right now. We're not tiring out. We're ready for the next round, because the next round is where we make serious money. So that's just what I wanted to say. You can be bearish on whatever you want, but you're always wrong. Yeah, you're right for a little bit, a short amount of time. These are quarterly candles, right? So each one of these candles represents 3 months. So if you look at the past 6 months, we're down. Or I should say the first 6 months of the year, we're down, which we haven't had in a while. Look, here's the pandemic drop. That was 1 quarter. In fact, that was actually only 1 month of that quarter. So towards the end of the quarter is when this happened. This was a green quarter until the pandemic crash happened for 1 month, right? Here's the 2018 crash. That was 1 quarter's worth of time. We had some uncertainty at the beginning of the year for a quarter. Back in 2016, or when the election was coming up, we had some uncertainty there. That's also when interest rates started to come up, so there was a lot of uncertainty in the market, but it continued. All the naysayers that said the dollar was going to crash and we're all going to die, so you got to buy gold, well, they're out, right? Gold is, that's what a lot of these people are doing. They're trying to sell you gold. So when somebody says the world's over, and then they're like, oh, I have a cure for that, buy the gold. So that way when the apocalypse happens, you'll have a bunch of shiny metal, right? In fact, you could buy it where somebody else holds it to where you don't even hold it. It's mostly a scam. Like, gold is a good idea to have. It's always good to have a physical asset that has retained value for a long time. And there's nothing we have that's retained value for longer than gold. So I'm not saying gold is bad. I like gold, but I just don't think you need to liquidate your portfolio and buy all of it, because that's a recipe for disaster. So do you watch Market Traders TV at all? I mean, gold is finite. Yeah, sometimes I tune into their stream. I've seen it. It's usually just on an automatic thing, like there's a video playing in the corner and then it's just showing charts. But once in a while, I'll actually see someone on there talking. So are they all about gold? Because, you know, I'm not, like I said, I'm not saying gold is a bad thing. I'm just saying the people that are trying to sell it to you have an agenda. And part of that agenda is to make you think the world's going to end, because that is bullish for gold. Right? Anytime there's been a crisis for thousands of years, for longer than the stock market, the bond market, and all these markets have existed, gold has always been good when times get rough. And it's going to continue to be, because not only is it a shiny rock, but it does have uses. It has uses in technology. It has uses in chemicals. It has uses in style, like jewelry and things like that. I mean, there are so many things that you can do with gold, and not just superficial things, like actual, real technological things. So gold does have value, and it is finite. The problem with gold is there's a lot of it in places that we're probably going to get to soon. The bottom of the ocean, in areas where we just really can't send craft right now, there is a ton of gold down there, apparently. You know, I haven't researched this too far, but from what I've seen, there are areas we just can't get to that we know have huge gold veins, and someday we're going to be able to mine it. Not to mention, at some point, if we ever get to Mars, which we probably will at some point, then we're going to start hopping to asteroids and things like that. There's tons of gold out there. So yes, I know that's quite a bit in the future, but for now, gold is finite. But as time goes on, it may not be finite. So there is always that too. Like, that's why I say don't buy everything in gold, right? It's like, gold is a good thing to have, but if you're all invested in it and suddenly we find out how to mine it from the bottom of the ocean floor, well, guess what's going to happen to the value of gold and everything you own? It's going to go down quite a bit. So let's see. Oh, gold is also very stable. Yeah, no, gold is stable too. That's a good point. That's why it's good in a crisis. And when you look at gold, in fact, let me switch this to the GLD real quick so we can look at an ETF of how gold is trading. Not the best indicator, but it's something. So you can see that when things were going down, or when things were going up, gold went down, right? So we had the great financial crisis, 07, 08. Everything went up because people thought, oh, it's over. I need to be in assets that matter. And that's what pumped it. So anybody that sold in here was happy. But if you held, it took 10 years to come back. So that's the nature of gold. Like, when we went off the gold standard, it rocketed exponentially, but it hit a ceiling because people realized, like, it's semi-finite. It's finite until we find a way to make it not finite anymore. You know, it's like Bitcoin. We can only print 21 million of Bitcoin. That's all that can be mined. Yeah, unless you fork it. It's the person factor. It's not like the technology when people say, oh, it's only that. Nah, people can always change it. So it's finite until we decide for it to not be finite. So what do we have here? That's the stable I was talking about. Yeah, so it's stable, but are you going to make a ton of money on it? No. It's more as just something to have as a hedge, which is why I like it. Like, I think it's good to have it as a hedge and have it in physical form, right? Not just an ETF, because it's like, that's paper. Somebody else owns that gold, and you don't even know if they have the gold that they say they own. That's the problem with stuff like this. There's like Tether was going through that. Tether was, oh, do you have enough US dollars to back the amount of Tether you're selling to people? It's the same thing with gold. Do you have enough physical gold in your vault to back the amount of shares you're putting out there? Something like the GLD, yeah, it's a well-known product. They're going to see what is included in that. But like something else, you really have no idea. So I like physical gold in hand, if possible, much more than something like an ETF. But if you just want to trade it, ETFs are a great way to go. And gold's actually been a decent trade when things go down. I mean, it's usually inverse to the market. Not always. Sometimes it's not, but it's usually inverse to the market. So let's see. Plus, if you have gold hoard in person, you can tell people you're a pirate. Well, there's that too, right? You got the gold treasure. And, if there's ever like an apocalypse, then you got to defend that gold and stuff like that. Or you just don't tell people you have it. Of course, if there's an apocalypse, your gold's really not going to be worth that much. Maybe it'll be good as a currency, but maybe nobody care. Maybe food will be a currency. I don't know. So, yeah, it's the end of the world stuff. That's their selling point on gold. So you can't get too caught up in that. It's too bearish of a world. And there's too much incentive for people to tell you that things are negative. So anyway, the whole point of that was it's been wrong for the entire history of the world to bet against our species. Right there. That's it. You bet against the species, you've always been wrong. How long has our species been here? Like hundreds of thousands of years for this version, or millions if you count the other hominids too? It's always been wrong to bet against us. So why do it now? Why is it different now? We've had the ability to destroy ourselves for a long time, and we haven't. Yes, we might. I understand that, but we still haven't. And even if we do something crazy like try to nuke the planet, there'll probably still be some people surviving, because that's how we're annoying. We are like a virus. We just hide in some cell somewhere when the immune system comes to destroy us, and we're ready to go as soon as it goes away. It's like we're like the T-Rex in Jurassic Park. Freeze for a second. It can't see you if you don't move, and then it goes away and you move again. That's our species right there in a nutshell. Let's see. I feel like cans of Chef Boyardee would probably be the Armageddon currency. Yeah, probably. That stuff's gonna last forever. You get your like 3 meatballs in it and a bunch of spaghetti, right? Let's see. We haven't yet. In an apocalypse, the only valuables are weapons, food, and medication. Yeah. I mean, that's really what you're going to need. Like gold. That's why I say it's like gold's only valuable up to a point. If a society continues or forms after that, then gold will be valuable. But like if it's a real apocalypse, which honestly is extremely unlikely. Yes, it's on the table, but it's extremely unlikely because of what I said before. Our species is just too freaking good at surviving to do some shit like that, right? So, probably sterilization supplies. Yeah, that would be another one. Sterilization supplies, medicine, all that kind of stuff. Anything that you actually need, like real valuable stuff. Let's face it, the single most reduction in death in history of the world, it has been sterilization each time. Like as the species has gone on, not just in that sense, but like things have improved over time as our knowledge has increased. And that's going to continue too. We're going to learn about things that we don't know right now. We're going to be able to deal with problems that we can't deal with right now. That's the other thing people are kind of discounting about us. It's going to be tough to get there, but I still think the odds are more likely that we do it than we don't. So let me get back to this. I was talking about these different things. We were on Kroger. They made more money. Their revenue came in at $34.6 billion. The estimates were 34.2. So they beat that. They beat revenue. They made more with it. That's why I always pay attention to EPS, earnings per share, and revenue, because those two things together tell you how a company did. Revenue is the total amount of money that comes into the company, and earnings per share is how much they actually made with that money. Because you got to think, when you receive money, you have to pay your bills, you have to buy, you buy the product, you have to pay that, you have to pay the workers, the plant's failing, you need to get a new machine, stuff like that. So after all those expenses, Kroger was able to make more than the estimates thought they would make. And they brought in more money when they did that. So sometimes you'll see they'll bring in less money and make more. That's also bearish, because it shows you, hey, they were efficient. They did well, actually. So even though they didn't bring in as much money, they made more with it. So the end result is better for the shareholders. So you always want to pay attention to that. The earnings per share and the revenue. There's going to be a whole bunch of stuff that you see around earnings if you follow an earnings report, but those two numbers are the most important ones. Sometimes I'll pay attention to some other stuff. Like in this, I don't think I've really talked about same-store sales before, but Kroger had a boost of 5.8% in their same-store sales, meaning those stores sold 5% more stuff than they did last term. So that's a good measure because that tells you people in that area are buying more. When everybody's saying, hey, we're going into a recession, everything's going down, they're actually buying more in these areas. So that tells you grocery stores, they're an essential. You need those things, right? So people are going to go there regardless of what's going on with the condition, or they're going to order from there if they can't go there. So Kroger was a great pickup. That's why I thought, all right, when it was in here and it was kind of trading sideways for a few days, I think I bought it maybe like Monday, Tuesday, somewhere in there, perhaps Friday, the week before. I thought this is going sideways. This is looking like it's going to be okay. Yeah, I bought it in here, I remember, because it went up and I was happy, and then it went down and I wasn't so happy. But it was a good idea. So if the market goes up, I'm going to hold those and dump them for a little bit of a profit. But that was basically my only good trade in the past 2 weeks was Kroger, I think. I might have had something else. I took some stuff for profit off the table to get cash, but that was an actual trade right there as Kroger. It took me about, 4 or 5 days to make that. Moving on to the next stock. So another one, this was a gamble for me altogether because I really don't pay attention to this stock, but NEO had earnings. They didn't do that well on earnings. And the next day, it kind of came up a little bit. So I had some calls going into it. They were already down. When the event happens, the price of your calls shrink quite a bit. So basically, if you bought something for let's say you bought calls for $50 before the event, something happened or the event happens and then it doesn't go anywhere, those calls will shrink in value by quite a bit because leading up to the event, the premium increased because there was more risk. When you know there's an event coming up, a binary event like earnings, you know that the stock could move huge. People want more money to take the risk selling you those options. So they'll be more expensive, right? So if you buy them right before an event and nothing happens, it's basically the same as losing. Even though, look at this, NEO actually went up a little bit, right? They were higher than they were before earnings, but because premium had been crushed out, they were basically not next to worthless, but I lost a bunch of money on it. So I dumped those right in here. Now I wish I had held because it came up to here, which is above where I bought them, which would have been nice because there was still time left on those. But with options, normally you just want to get out while you can because premium decays quickly if things don't happen. Options basically wait for a little move, and if it doesn't happen by the middle of the day or late in the day, those things are going to tank in value. So I needed to get rid of those things quickly just to make sure I didn't lose more because I thought it was going to trend down after the results that it gave, but it didn't. So, there's other stuff with China as a whole because this is a Chinese automaker. It makes electric cars because there's other stuff with China that also brought it up, right? There's some positive and negative news that affected the whole sector. So, it wasn't just the earnings and all that. So that was another one I kind of wish I'd held a little bit more, and I was right about it after a while, but not on the actual earnings. It just didn't move enough to matter if you're going long. This would have been the time to sell options on it and suck that premium out when it doesn't move the next day. So what do we got here? Well, the stock market moves fast when it moves. Yes, it does. It moves quite a bit. And certain stocks like NEO, and so let me see how big is the float on NEO? 1.6 billion. So this one is harder to move because it has a huge float. So remember earlier I was talking about float. That's the amount of shares that are available for trading. When you look at how many of those shares there are, the fewer there are, the more it can move because the scarcer it is. The harder it is for people to get shares they want. Or if they're selling, get out of those shares and find buyers. So prices can move really quickly when there aren't a lot of shares. Now, 1.6 billion shares is a lot. It's not the most. You'll see companies that have more than that, but I'm looking for less than 100 million. Like if you see a stock that has less than 100 million shares, like for example, GameStop. In fact, they actually had a split recently. So they have 500 million shares. This used to have like less than 100 million. So GameStop would move quite a bit. That was what caused that big squeeze back in 2021. It was a combination of a lot of things. One, people just didn't believe in GameStop, so they shorted it way too much. Two, it had a low float, so there weren't a lot of shares available for trading, meaning if those people shorting it had to get out, they were going to have to buy expensive shares. So low float, high short interest, and an event that moved everything up, right? The Wall Street Bets thing, the Diamond Hands thing. So you got all of those three factors coming together, boom. And recently they had a split. So they're a little bit heavier of a stock. It's going to be harder to move the stock now, although it can move. So don't think just because something has a lot of shares that it can't move, right? It can still move. There's always the chance for that. It depends upon what or who is in that market, what buyers want to get that. So I thought GameStop shut down. Nope, they're still alive and kicking. They're doing their thing. They're trying to adapt to the market, but they're a physical brick and mortar store. It's just so much harder for people, especially if you're lazy, right? Who wants to go into a store and talk to people with like how many people have issues with that right now? How many people have social anxiety? It's so much easier to just do it online. So the trend is that they're basically screwed in the long run. It's going to be very hard for them to keep their business. I wish I really don't like that, because I'm a brick and mortar fan. I like to go into places and look at things. With games, it's not that big of a deal because you can preview them online and stuff. But with something like furniture, like if I want to get an office chair, I need to sit in that thing first. I don't want to order a bunch of them and have to put them together and send them back. Like, no, that's stupid. You can do that with clothes, but trying to do it with something you got to put together, and something you're going to use a lot that has to do with your comfort and, your posture and all that. No, I want to see it. So brick and mortars to me are necessary, but they have an expense that the online stores don't. Brick and mortar, they have to pay rent, they have to pay electricity, they have to do all this stuff. Online businesses, they can rent space, or sometimes they'll build their own. Like, Amazon's kind of doing both. Most companies are actually doing both. You'd be surprised at how many companies are renting space and don't own it. Like Home Depot, Lowe's, all that product they have, they're renting places to store that until they send it to the actual stores themselves. So yeah, I got off on a tangent here. Let me go back. Let's see, what did it say? I can't remember when I bought a physical game. Yeah, me either, which is sad because I used to love to go into the store and look at the games. It was so much fun to just actually, look at movies in a movie store, look at games, all that stuff. When you're on your computer, on your phone, your console, whatever, you're just kind of scrolling through menus. It feels endless, Like, that's why Netflix kind of sucks for me. Like, I watch the good stuff on Netflix, and then I just spend 45 minutes looking for something, never find it, and then turn it off. It just, when everything's right there in front of your fingertips, you have too many choices, and you don't care about any. You hate it all, right? If you have fewer choices, you appreciate them more. But if you have a ton, you hate everything, and then you're depressed because you hate everything. So, let's see, that makes sense. Digital games made physical pointless. Yep. I do have that nostalgia for physical copy, though. Yeah, there is that. People that grew up with it really do, because there's just so many happy memories of going to the video store, going to the game store, whatever. Those were like the best times when you were a kid if you had games. Like, I'm a millennial. I grew up in the 90s, basically, and that was when this stuff was really coming in. I remember being one of the only kids in my class when I was really young that had game consoles. Most people didn't. Now it's like everybody's got a console, everybody's got a phone, everybody's got a computer. But at the time, if you had a computer and a console, you were rare. You're very, very rare. It picked up over time, but it hasn't been that long since this stuff came into play. Let's see. I do love the fresh manual smell. Yeah, I know there's something about opening a game or opening like a movie or something, and you smell that new, like, burnt plastic or whatever it is. Probably terrible for you, giving you all kinds of cancerous chemicals. But it's still, like, it brings back good memories, right? Like, I had an old car that, like, smelled like gas. So sometimes I smell gas, and I'm just like, it can kill you, but it just, brings up good memories. So I'm talking about. So, all right, let's get back on track. So we were talking about Kroger. We got to Neo. They disappointed. They were estimated at negative 17 cents for EPS. They ended up being negative 20. So that's why they dumped a little bit. They brought in a little more revenue. It was 1.5 billion, where the estimates were 1.4. So they didn't, they beat there a little bit, which was good, but they made less with it, which is bad. But then, China's looking like they might actually come to a deal with the U.S. and let them audit some companies, which means Chinese companies will be able to stay listed. That's what this whole thing is. China is very secretive about everything, and their companies are tied into their government. But the way the stock market works, and any of the markets that are involved in the U.S., is we want transparency. And the reason we want that is because we've had so many times throughout our history where, like, big robber barons have scammed people, or there have been pump and dumps by extremely wealthy individuals that own most of the stuff. They were able to move things, and we didn't know what they were doing. They could have sold whatever they wanted to, and we wouldn't know about it. Just all of a sudden, the market would be down. So that hurt a lot of people. The common people that have these stocks and these investments in their pension funds, in their retirement, that hurts them directly. Like, people who have a ton of money, oh yeah, maybe they lost a few million on this. Maybe they lost, something on that. Big deal. They still have this huge fortune. But people that don't, if they lose everything in that one downturn, that's terrible for them. So that we've slowly over time added rules, the SEC and things like that to investigate this and make sure that companies actually put out their information so we know what they're doing. If you're going to make an investment in a company, you need to know what that company is doing with its money, what it owes, what's happening, so that way you can make a decision to protect yourself if necessary. Right? But if you look at other countries, they don't always have those rules. So you could say what you want about America, but we have really transparent investing rules, which is wonderful, because some places really don't. And that's when you don't, scams can run amok. Scams can still happen in the system we have, but at least it's open enough to where investors can be like, all right, the company made this much, earnings per share, all this stuff. They didn't used to have to report this. This was, basically we regulated it and forced companies to do this every quarter. Sometimes there's some people that want it to be every half so that they only have to do it twice a year instead of 4 times a year. But I like quarterly because I want to know what's happening every time. Because if you have to wait half a year to know what a company's done, I mean, they could make so many moves in that time. And by the time the report comes out, you don't have time to react to that. So it's really good that we have this transparency, and we're trying to get China to do the same thing. But because they're very secretive, it's a national security thing. It's not just a company thing. They want to make sure that things are locked down. So we've basically been in this stalemate with them for years, saying, "Hey, we need to know what your companies are doing with the money. We're not trying to, get all this information." Well, I mean, like, I'm sure the alphabet agencies are, FBI, CIA, stuff like that. They want the information, but investors just want to know what you're doing. Right? We're not trying to take down the CCP. We just want to know what the companies are doing. I think it's fair to investors. So whatever exists on the political side of that argument, that's the core of the argument. And it looks like we're coming to some kind of an agreement where U.S. auditors might be able to see those finances, which is extremely bullish, because if China doesn't let the auditors see this information, their stocks are going to get delisted. The regulators are going to delist Chinese stocks, which would be massively bearish for the market, because that's a huge chunk of money that's in here that would just disappear suddenly. So this is important. Like, getting this resolved so they can stay listed is important. And in fact, I think if we don't get this resolved, we're just going to continue this kind of sustained what-ifness. It's like every war we've seen in recent history has just been designed to sustain. It's not like we're going in to win a war, or like any kind. Like, what do you think is going on with Ukraine and all that? Like, why they should be done with this stuff by now, but they're just going and going. Like, everything wants to be sustained. And that's probably what they're going to do with this. They don't want to delist the Chinese companies because of how much of a chunk of the market that would affect. So they're going to just keep kicking the can down the road in any way they can. Eventually they could delist them completely. I think that's possible. I think that would be more a political move than an actual, financial move, because there are a lot of people invested in these. There are a lot of 401ks and pension funds that have Chinese stocks in them that depend on that. So because a huge chunk of the country, whether it's indirectly or directly, is affected by that, they're going to try to not have that delisting happen. So this is bullish if they actually come to some kind of resolution, because every time I see a news article that's like, "Oh, we've made a step in the right direction," 2 days later I see an article that's like, "Oh, no, China doesn't like it, so we're taking another step back." So who knows if this is going to resolve. But if it does, all these Chinese companies, Alibaba, Tencent, Baidu, Neo, etc., they're going to pop. That's why these jumps keep happening. So I've been keeping an eye on that. I was hoping to get a little jump in Neo, but I missed it. So there was a loss there. So DocuSign, I missed out on. Could have had some gains. Kroger got some mild gains, hoping for a little bit more next week. Neo, missed out on it. Not really doing anything there now. That was just kind of a stupid gamble. We got a couple of things here. Correct me if I'm wrong, but it seems to me that you need quite a bit of money in order to really get into the stock market. Yes. You actually do. You can trade with a smaller account like I do and like a lot of people do. But if you want to make a whole bunch of money, if you're coming in to think like, "Oh, I want to be a millionaire," yeah, you need a lot of money to start with. Like, you could become a millionaire starting with $1,000 or whatever. But I'm going to tell you right now, it's hard. You're not going to make progress very quickly, because the way to make progress quickly is to make risky investments. And risky investments are going to wipe you out, especially if you have a smaller account. And just so you know, a small account is anything under $25,000. Like, $25,000 is the PDT, the pattern day trader rule amount, meaning if you have $25,000 or more, you can make multiple day trades per week. But if you have under $25,000, you can only make 3 per week. The whole reason that's there is to prevent traders from blowing themselves up, which I don't necessarily think it actually does, because I've been stuck in the PDT a few times. Like, there was, when I was first trading and I was making a bunch of trades, I got into something and had a profit, but if I got out of it, I would have been banned for 90 days from trading. Because if you make more than 3 day trades, you get a 90-day ban. It forced me in that situation to take the loss because I wasn't able to get out of it. I could have made money on that if I was able to get out of that trade, but because of the PDT, I got hit. So that rule is in there. It's kind of dumb. I get why it's there. I don't think it's necessarily that bad, because people really shouldn't be going crazy with trading and making a bunch, especially when you're new. But it can hurt you too. Like, if you really need to get out, because that happened to me multiple times. Like, early on, I thought I had another trade, or I wasn't paying attention to it because I didn't know it. So it got me a few times, but I never got banned, but I did lose money twice because of that stupid rule. So if you have less than $25,000, you can make money. It's doable. I think $5,000 for in a trading account is great. Like, I have 2 trading accounts with $5,000 in it. And then I also have my long account that I put the winnings in and whatever money that I make outside to grow from there. But that $5,000, that's why I keep it at that level, because that to me is a safe amount of money to risk while still being able to make enough to survive. Now, this is a side hustle for me. This is not my main income. If you want to make this your main income, you got to have at least $100,000 or more. You want to be trading with like a few $100,000 minimum. If you really want to survive, you have to have like $1 million account. That's just my personal opinion. Like $50,000 is good. $30,000 you can work with. That's doable. But really, if you want to have consistently good gains and be able to make it your main income source and like pay your mortgage, pay your rent, whatever it is, you need to have a good amount of money, at least $100,000 or more. So if you're like me and you're using these like $5,000 accounts, or if you're using $1,000, if you're using $500, just make these little trades, learn the market, and practice. So yeah, it does take a lot of money, but you can do it with less, like I'm doing. And you can build up over time, like I'm doing. I actually have been successful at doing that. I that one investment I made where I put in about a third of my net worth, that sucked. But I stayed in the market, even though I wanted to quit. I had 2/3 of my money left, right? There are people that will bet the farm on an investment. You never ever do that, especially if you don't have a lot of money, because when it's done, it's done. But if you practice, if you paper trade for a while and then you start getting in the market with these little advancements and you're just saying, hey, this is my side hustle. I'm going to work my 9 to 5 and I'm just going to trade every so often when I see a good trade. That's the way to do it, because over time that builds up, and you'd be surprised once you get going how quickly that actually does. So let's see what you said in response to that, because I'm missing a ton of chat. For certain strategies, yes, others no. So you kind of said what I said. Well, you can do small trades here and there and get into it. Yep, exactly. I agree with what you're saying right there completely. Some strategies, yes, some strategies, no. You said, China is such a big part of the global market. Yes, definitely. But the government is shady. Yes, definitely. We just don't know. They're so not transparent that was the whole thing. It's like, we want to know what's going on with your companies. They don't want to show us. So we've been in this standoff forever. Exactly. So it's rough on the markets. But if that gets resolved, Chinese stocks are going to look so much better. I've wanted Alibaba for a while. I actually bought Alibaba at like 75 or something like that, and the next day it popped up to like 100, and I ended up dumping it right there. So that was a nice little trade. But I really just want Alibaba in the long term. At some point I want to own it in my account. So that's what if things continue to go down for a while, I'm going to add a little bit of that, because I think that's good to have diversification for not only your own country, but outside of the US or outside of whatever country you're trading in. It's good to have something to protect you in case one link fails, right? Have multiple trading accounts in case one, like, TD Ameritrade, for example, if they go down, I still have my other accounts. It's good to have diversification there. Diversification of strategies. I have the long account. I have these trades. So if the trades don't work, I have the long. If the long doesn't work, I have the trades. It's good to have more options there, right? And then inside those investments, I'm doing different things. I have long stock. I have long leap options. I have short options. I have a little bit of cash that I sit around on. It's a good strategy to just have these things in wherever they work best. So let's see. That's why contracts are more appealing. Smaller traders feel. Yes, become PDP doesn't apply to contracts. It does actually. You know what? It depends upon the broker and what the rules are. You can like for Robinhood, for example, right? I make a lot of my options trades on Robinhood because they let you do level 2 trading really easily. And a lot of other brokers don't. Like TD Ameritrade doesn't let you use spreads unless you have margin. And I don't want to use margin. So I'm kind of stuck with using brokers like Robinhood, Webull, stuff like that, that'll let you trade options. So I like the fact that I can do that. But on Robinhood and some other brokers, contracts are still subject to PDT. Cryptocurrency is not. It's a totally different thing right now until it gets regulated into being a security at some point, which it probably will, and then it'll be subject to those rules. But for now, crypto, you can trade all you want, but contracts and stocks both hit you for PDT unless you have a broker that says otherwise, or you're trading on a broker that's offshore, because there are different rules depending upon where it is. So it just depends upon where you are. See, backups are always good. Yes, I like that in life too. Like, for example, you got a bunch of pictures on your computer or something. It's good to back it up locally. It's good to back it up to the internet. If the drive malfunctions, if there's a disaster and you lose it, it's good to have it on the internet. But if, the site goes down or something like that you had it stored on, then you've got it on your hard drives, your flash drives, whatever it is. It's good to have diversification of your backups too, right? That's kind of my philosophy right there. So, Green Joker 23, cheers. Hey, how's it going? Good to have you in here. So you have your girlfriend and then your backup chick. Just kidding. Right, there you go, right? It's like everybody's got to have their backups, right? So with investing strategies, I think it's really good to have a diversification of not just your investments, but your strategies as well, and your means, whatever. It's important to do all that, but you can get too caught up in that too. So it's not the best to like go overboard and diversify so much that you don't make anything in an investment. You still have to rein things in. Like I don't have a ton of investments. I think my total amount of long investments is like 7 or 8 at the most, and that's including these long contracts, right? I have like 5 different stocks that are set to pay me dividends, one each month. So I get one at each section of the quarter, and then I have a growth stock. I have some speculative stocks, and then I have a hedge. That's it, right? And then I've got my leaps, which are actually trades or longer term trades. Whereas my long account I'm leaving that. I'm not touching it. That's going to be there when I'm 50,000 years old. I plan on doing that. I can put my brain in a computer, and I'll still be investing at that time, if there's even money. What do we got here? At work, but just wanted to say hello. Appreciate these kind of streams. Happy Sunday, peace. Yeah, thanks for coming in, Green Joker. I really appreciate it. It's good to have you on. So yeah, I've been trying to build a little community here, and I've been meeting so many awesome people. The Twitch community has been great so far. Everybody's so much fun. People are supporting each other going into the streams. I love it. So thanks for coming in. I appreciate that. Let's see. Dividends seem nice for a long-term buy and hold. Yes. See, that was another one of my strategies. I mean, it's good to try to trade and all that, but I want something that's going to pay me definitively. Like a growth stock is only going to pay you when you sell it. Yes, it's good to have some stuff like that because I think growth stocks are extremely important, and it depends upon what you're trying to do with your money. But for me, I'm trying to grow over time. So I have the growth, I have the specs. The specs you don't really expect anything out of, but they could blow up, so it's good to have. But the growth is where a good amount of your money is going to be as the market goes up. However, if the market doesn't do anything or that growth stock isn't as good, it's good to have some income coming in. Every month, I've got that drip. In fact, I've got 1 month has 2 payments. So I'll have like 2 payments 1 month, one the next. So it's like 2, 1, 1, 2, 1, 1. Now, they're not huge payments, especially since, I've got multiple dividend stocks right now. But over time, they grow because eventually you get them to a point where they can buy 1 share. So that's what my long portfolio is at right now. Like just getting to the point where the dividends can pay for 1 additional share. Now, if I never touch that portfolio again, compound interest is going to continue over time, and it's going to be worth a lot of money. Like think about people that bought stocks in the 40s or something like that, or the 50s, and they're retired now, but those stocks have grown so much, even if they didn't do anything to them. Just inflation brings stuff up. There are stock splits. Things just continue over time. So it's good to have that dividend paying you every month. And I've got it in the DRIP system, dividend reinvestment program. It takes the money that you get in dividends and it buys more shares. And the more money you get, the more shares you can buy. So the bigger you are, the faster you can grow. That's the sad part about money and the good part at the same time. Not having money hurts you doubly because you can't make money. You need money to make money. But having money lets you make money faster, which is why compound interest is so important. Einstein said something about people don't understand the power of compound interest. That's true. Because think about it, you're getting 1 share now, but that 1 share is bringing on more and more and more, and then it's 2 shares, and then it's 3, and then it's 4, and then it's like 6, and then 20, and then 50, and eventually you're getting so much each month, you don't need to worry about buying new shares. You've just got your rent taken care of and all that. That's going to take years, decades, whatever. But think about what else you'd be doing with that money. Are you going to buy the next console? You're going to buy PlayStation 5, PlayStation 6, and then buy a stupid game that you don't like? Hey, get the console. I'm not saying that's a bad thing. But you're going to buy all these stupid games. You're going to pay 60, 70, 80 bucks for these games, whatever they end up costing in the future. You're going to hate like 40% of them. And that money could have gone to buying some stocks. It's funny. I'll go to a fast food restaurant. I remember I was at Wendy's like 3 weeks ago, and I looked at what I was going to get. I was like, all right, this is going to cost me like 25, 26 bucks to get everything. What in the market could I do with 25, 26 bucks? I was like, oh, I could buy another share of one of my dividend stocks, and I could buy a couple of shares of one of the other ones. So what I ended up doing instead is I went home, I made a sandwich, and I took that 25 bucks that I was going to use at Wendy's, and I bought another share of one of my dividend stocks. So it's just like, instead of buying the money, or instead of buying the food, I bought something that's going to pay me. So that burger, I'm going to eat it, I'm going to poop it out, it's going to go away. That money just went like into my colon, basically. Whereas the money that's in my stock market is going to pay me over and over for the rest of my life. That 20 bucks, it's not much now. But you think about that 20 bucks is getting me like, 20, 30 cents in dividend per quarter forever, as long as, the stock stays up. So there is that. The stock could crash. But that's just how how I think about things now. Like I figure, all right, do I want to spend this money on that and it's going to be gone, or do I want to spend it on something that's going to make me money? Every dollar you have could either make you money or it could lose. You could lose it. Those are your two options. So what did I miss here? Oh, I didn't know about the investing. Never heard of drip. Yeah, I think drip is great. It's an automatic thing. Just does it. It takes the dividends every month, buys a new share for you. You don't have to do anything. And the wonderful thing about drip is that I don't think it's taxed. You tax it if you sell those investments, but if you're just automatically buying each month, it doesn't hit you with the gains that you would otherwise get if the dividend wasn't reinvested. So every year, you're going over your taxes or whatever. If you have something that you never sell, then you don't have to pay taxes on it. Or if you hold something for more than a year, you pay capital gains instead of income. And capital gains is 15%, whereas income could be anywhere from like 20 to 40%, right? So there's like the super rich, I think, have like 40-ish, 50, somewhere 40 to 50%, high 30s, whatever it is. It's really high. So depending on what bracket you're in, you could be getting hit hard with your investments if you sell before a year. But if you hold these things for more than a year and then sell, you're at that 15%. It's an incentive to keep the market up and keep people into stocks because that's what we want. We want people in the stocks. So what else do you say here? I agree. I mean, I've never paid much attention to stocks and such, but you've kept my interest. Keep at it, man. You're doing great. Hey, thanks. I appreciate it. This is just my way to vent and have fun. Like, I really enjoy talking about this stuff. And up until I started this stream, nobody wanted to hear it. Right? I know none of my friends were into investing up until the pandemic drop, which brought a bunch of people in because the market went crazy. But up until that point, nobody I was talking to cared. Right? So I'd be running my mouth and people were just sitting there like bored and looking at me like, when is this guy going to stop talking? But now I get to go on here and talk to people that actually care because this stuff is important. This stuff is great. And you know what I love about economics and all this? It's not just about money. It's about behavior. It's about how the world works. You learn so much when you get into finance and get into stocks because you don't just learn about money and you don't just learn about how stocks move. You learn about the businesses you're trading and investing in. You learn about how the actual real world applications work, which is wonderful because it expands your mind. And when I was a kid, I just thought, oh, it's money. Money's the root of all evil. It's dumb. Like, yes, there are scams. There's corruption. There's all that. But there's the other side of it too, which is mind expanding. It's so incredible. And I wish more people were into it, which is why I love doing the show, because I want to talk about it and tell people that, hey, this stuff is actually really interesting and it's actually very beneficial. Right? Because like I was saying before, if I just bought a few shares of Apple and Amazon when I was like 10 or 20 or whatever it was, by now I'd have a ridiculous amount of money. I didn't have to know anything. I could just be like, oh, that looks like a good company. I use those products. iPods came out back in the day. You could be like, oh, iPods and iPhones. I'm just going to buy a little bit of this Apple stock. I mean, maybe in the moment you wouldn't have made that much or you would have lost money. But since then, a ton. So I think it's extremely important. I want to get rich so I can do philanthropy when I'm financially set. Yeah, you and me both. I would love, there are so many things I'd love to do with my money charity wise. I think that's kind of what's going to happen with people. We're going to have these quote nouveau riche type people, like people that newly have money because the way the economy is working is changing. Like streamers are a new thing, right? You think about these really famous streamers, there's people that are making ridiculous amounts of money, famous YouTubers, TikTokers. That's a different kind of economy than we've had. So we're going to have a different kind of mindset behind the people that have the money. Like the old money is still going to be there, but the new money is going to be a different type of person. And I think that person, while yes, there are a lot of dumb streamers and YouTubers and stuff like that are probably going to do terrible things with their money, there's also a lot of conscious people. There's people that are socially conscious, environmentally conscious, moving things in a direction that's more positive, helping the environment, which we need because we live in the environment, helping people who are disadvantaged and could use a boost. Because like I said with money, having money gets you more money, but not having money counts against you. So elevating other people out of poverty is extremely important. And I think philanthropists that come from this new economy are going to do that more than people did in the past. I'm an optimist. Like, I'm definitely at heart, I have a lot of pessimism, yes, but deep down, I am an optimist. And the reason I'm an optimist is because of trading. I used to be a pessimist. I used to believe that the world was going to be over. But then when I saw this right here, SPX, like I showed you earlier, and I thought, oh, wow, this has gone on for forever. I mean, like, it's stupid to bet against this. And this is a reflection of reality. This isn't just the money. It's like, oh, the stock market is its thing. It's separate from the economy. Yes, you're right. It is separate from the economy. But it shows you the moves in the economy. Things went down because businesses had problems. Like the 2020 lockdowns meant that businesses couldn't do anything, which is why the market dropped. It was response to an actual historical event. And then the pump was the same thing. We reopened up. People didn't think it was going to happen. People thought it was over. But look at what happened. We made new highs, and we're still there. We've come down almost 50% from the highs we made since the pandemic, and we're still up. Like, people that bought money on this ride, even though they've lost a bunch in the past 9 months, are still up. So it's better to be an optimist in the long run. Like, if you're a pessimist, you're going to get hammered, which is going to make you more of a pessimist. It's going to hurt to be a pessimist. So why do it to yourself? Plus, if we have enough problems to where the bears are right, we're not going to be worried about the stock market anyway. So just do it, man. Just make your money. Whatever it is, doesn't have to be in stocks. Just take your money and use it positively so that you can actually plan for the future. Like, finance is a part of your future. Finance is a way to allow yourself to do things. Okay, so let me see here. I think we're getting a little, I'm going on this long rant. We've got a few things in chat. Let's see, Conscious Investing 101. I appreciate how you break it down. You're welcome. I'm trying to do that. I know what it's like when you're starting and, when you've been in the markets for a while and you're looking for information. That's what I want to do. I want to bring all the information I found to people that are at my level or lower when they're learning. Like, it's just, there's so many traps you can fall into that are unnecessary. It's way better to have somebody that's been there go, hey, this is how I got by it, or this is how it hit me, and now I'm dealing with it in a different way. So there's that. And then we also have, I think you'd be more of an optimistic realist. Hey, maybe. Yeah, I mean, because like my optimism isn't just pie in the sky. Like I'm a converted pessimist. So maybe the realist is actually a good point of that. Because I used people who are pessimists tend to say that they're realists. They're like, I'm not a pessimist, I'm a realist. Well, not so much. Because things are bad, but they continue to be better. So you're actually just thinking of you're in a fantasy, you're in an image, you're in a political idea more so than anything else. It's the media, it's everything else that keeps people thinking that things are worse. But when you look at actual data, like forget the media, forget what people say about how we're fighting and how it's there's a civil war. You've seen that one yet? Everyone's talking about civil war. There's not going to be a civil war. All right. There's going to be a bunch of people that argue for sure. Yes. And things are going to get bad in some areas. Yes. We're not going to have an actual civil war. That's hype. So buying into that is just going to get you crushed. So get rid of that. And plus, if you don't think about it, there's one less person that will be driving, that will be fueling it. Like the more attention you give to that negative stuff, the more power you give it. The only way to keep it from coming to fruition is to take away its power. And the way you take away its power is by not focusing on it. That's it. You don't go in and fight. Everyone wants to fight. I got to prove I'm right. I got to say my point, blah, blah, blah. No, you exit the fight and you do something. Right? You have to do something real. You don't just exit and sit there. You actually live the optimistic lifestyle that you want to be. You ever heard that quote, like, be the change you wish to see? I hear that thrown around everywhere, and people don't get it. It means act the way you would act if the stuff has already happened. Be in that world. Be an example of the world you want people to live in. You want to live in yourself. You don't get there by arguing and yelling at people and telling people, no, you're not supposed to do that. No, you get there by building the thing and saying, hey, look at this. I did it. This is how I did it. You can come join me, or you can keep fighting in your stupid little circle there and never get anywhere. So there we go. Absolutely. But yes, continue with your explanation. Sorry for the tangent. Hey, that's all I do is tangents. But we are getting close to 5 here, so I'm going to have to start winding things down. I think I talked about all the stocks I wanted to. Yeah, DocuSign, Kroger, Neo, and Snapchat. That was the last one. Okay, so Snapchat. Let me get on that real quick before we wind down to the end of the show here. A little crypto news, and then we're done. So Snapchat. I've been talking about Snapchat forever. I think I mentioned it on every single broadcast I have since like the beginning. But I'm long Snapchat in leap options for the absolute longest term future I can. I've got 2024s right now. I'm not expecting this thing to come up anytime soon. But what I like is the more something gets beat up, like Snapchat, if I go over here to the longer chart so you can see what it actually looks like, the more something gets beat up like Snapchat, the cheaper the long options are going to be on it, which is why I like buying leaps. Because the more time you have on a contract, the more expensive that contract is. So if everybody hates it and those contracts that would normally be expensive start to become cheap, that's when I like it. And the reason it's cheap is because look at this. I mean, this is a terrible chart. Get over here. This is disgusting. Who wants to own that, right? So here's the entire history of Snapchat right here. This is why I've been talking about it. So it IPO'd here around $30, and it did nothing but trend down. Yeah, it had a pump here, but it was just trending down until it was about $4, right? That was in 2019, so that was pre-pandemic. It got to about, or I should say $5, just below $5. And then it started to come back, but nobody believed in it. And the thing about Snap is it's a huge float, so I wasn't expecting it to go crazy. But for whatever reason, this thing moves on earnings. Like, look at this one right here. Big move on earnings. That's an early one. When you start to get over here, where I drew this line was showing the IPO price, because for like 2 years, this was the price to beat. I IPO'd and it never got back up there. So in 2019, when this thing had been rolling around for a while, I thought this was a terrible stock. I didn't use Snapchat. I still really don't, but I did kind of take a look at it finally. But I do know that it's useful. It has actual utility. So it's not just some stupid penny stock that doesn't have anything behind it. It's something that tons and tons of people use. And the reason it started to go up is because their user base kept growing and growing, and they were able to monetize it. They sell ads. People on their platform have like a premium Snapchat where they can sell products or sell services. They take a chunk of that. There's so much they can make. Like any social media company has the ability to make a bunch of money in different ways. So once the stock finally trended its way back up to the IPO price, look what happened. Earnings, boom. One of the biggest moves the stock ever had. I mean, going up, I should say, because this is a pretty bad one right here. But that shows you right there, there's a lot of firepower behind the stock. So when this move happened, I was like, oh, that's a once-in-a-lifetime move. It's not going to happen again. Well, we get over to the next earnings season, boom. In fact, let me zoom in a little bit. Yeah, so you can see right there. So there was that first jump, huge jump up. I remember I was long here. This is why this was upsetting to me. So this was like, I think right at the end of 2019. Yeah, I was long here. And I expected a bit of an upside move, but because I had bought my contract somewhere in here, it was like up every single day until that. Oh, this is week. It was up okay. So I was buying more in like this area. So I bought like the week or two leading up, and I was right before the earnings thing happened. My contracts were up quite a bit. I think each one was up like $50 to $100 or something like that. So I thought, you know what? I've made a good profit right now. I'm just going to get out of it and see what happens on earnings. Well, I should have stayed in, because, oh man, look at that. It went from 29 to like 43 or something. Yeah. And then it trended up over time. I could have held it even longer if I had long enough contracts. Then we get to the next earnings announcement. Boom. Huge jump again. I didn't think it had more left in it, but man, it jumped right again. And these are gap ups, right? So if you look at this on the daily, you're going to see that this was floating down here. Earnings came out, and the next day it just gapped up to here. And that's what happened each time, right? And then you start getting to where it settles. The point is, during that time, it was trending sideways for a while, and I thought, okay, it's had this big blast once. It had a big blast again, and then this earnings announcement over here, it kind of did nothing. So I thought, all right, it's over. It's not going to do anything again. It hit its high. Well, no, it didn't. It had another explosion. And what was terrible about this one is it was the same thing. I was actually long. I think I started getting long in here, and then the event got close enough, and like I wasn't down. Like the stock had gone down, but my options weren't down because the volatility had pumped up the price. So I was basically at break even, and I thought, I don't like this. I'm going to get out. And what do you know? Same exact thing happened. I missed it twice. I could have had nice gains on both of these, but I got out because I was afraid of what was going to happen. And then we had this one. I actually didn't play this one. I was expecting another upside surprise, because every single time it was up. So I thought, all right, just going to do it again, because people bet against Snapchat all the time. But it crashed that time. So I'm glad I didn't try to go long. But if I had gone short, man, that's the biggest move in Snapchat history. Those would have been expensive contracts to have. I mean, they would have been super cheap up here, because everybody was thinking what I was thinking. It's going up. It always goes up. I don't want to be exposed to the upside with my risks, so I'm just either not going to play it or I'm going to go neutral on it. Well, boom, crash. So the whole reason I'm bringing this up is because this stock moves a lot on earnings. And you can see, yes, that was an earnings move right there. Boom, down earnings. And then it gets to this next one, pumps up again. But this is while the market is trending down, because now we're into 2022. So it has to move with the market. But you can still see earnings, boom. Earnings right here, not so much. This was a very mild one. What happened here? Boom, big drop. This one I was actually long again, because I was thinking maybe this is the bottom. So I got destroyed on this one. This was pretty bad. It's probably one of my worst trades in recent months. But since then, after that point, I started buying long calls, and now my calls are like double or triple what they were, because I bought them here. When something like this has happened after a huge down move, you've had multiple really big gap downs on earnings or whatever, people are so pessimistic. They think this is done. They think this is it. This is the last one. This stock is done. This is what I like. Like when I saw the stock sitting down here, even though my short-term calls got destroyed, I thought, okay, long-term calls are looking really good. Buying them super cheap. They have not come back down to that price, even though the stock has pulled back a bit. The calls were so cheap down here that I just have enough premium to where I'm secure. They're actually one of my better positions. I think Snapchat and the long contracts I have on Canopy Growth are like two of my best positions right now, and they're pretty much long. So I got some questions here. Snapchat did fall off a bit. Didn't realize it blew up. What is a contract exactly? So when I'm saying contracts, I'm talking about stock options, and an option contract is basically it's a contract that lives above a stock, if that makes any sense. So the contract is based on how the stock moves. So you can either buy the stock itself outright and take losses or gains on movements in the stock, or you can buy options contracts, which allow you to either sell a stock at a certain price or buy a stock at a certain price. A call option means you think the stock's going to go up and you want to buy protection against that so that you don't miss it. Let's say there's a stock sitting at $100 and you think it's going to go to 150. You could buy the $120 or the $100 call, and if the stock does go up to $150, your call option allows you to buy that stock for the cheaper price. So if you have the 120 and the stock goes to 150, you get to buy it for $120. So that means you're instantly up $30 a share when you get it. So it's basically, to put it simply, it's insurance on the move of a stock. So if you're worried about it going down, you can buy a put option. So let's say you have the $100 stock. You're worried about it going down to $80 or something. You can buy the $100 put, and then if it does go down to $80, you get to sell it at $100. So you basically paid a premium to protect yourself. It's exactly like buying car insurance or home insurance. Like you have it in case the event happens. But if the event doesn't happen, you lose all your money, or all the money you put into that insurance, I should say. So let's say you bought an option for $500. Maybe that option controls $50,000 worth of shares. So you're taking a small risk to protect yourself on that $50,000. But if you don't need it, then the $500 you paid for that protection is gone. So the reason I trade those is because the premium moves so much. I don't actually buy the shares. I just buy the contracts and take the difference in the gain or loss there, because there's enough money to be made just in those that you don't necessarily need to have the shares. And what I like about the contracts is it allows you to trade with less money. So if you have a $1,000 account, let's say, and you're looking at a stock, each contract controls 100 shares of stock. So if you have $1,000 and you want to buy 100 shares of something, it's got to be a cheap stock. Otherwise, you're not going to be able to do it. But if you want to buy a more expensive stock, you can get the options on it and you can make money that way, not have to have the whole amount. So instead of having $50,000, you can have $500 or $5,000 and make a smaller bet on it. So that's why I like options. It allows smaller accounts to move more, but there is risk to those. So option trading is extremely risky, and I'm not a financial advisor, so I highly suggest making sure you know what you're doing if you ever trade these things. They're not that complicated, but they seem really complicated, and if you get into the weeds with that stuff, they can be really complicated. But at their core, they're basically just insurance on a stock move. You either want to protect yourself from it going down or protect yourself from missing it going up. That's the simplest way I can put it right there. So I buy these contracts when there's a huge move, like I said with Snap. This is my kind of chart. I want a chart that's been beat up for like a year or at least a few months, and people think that it's done. That's when I want to start buying long contracts, because all the risk has been priced in, right? It could go lower, but because it's so low, the odds of it going significantly lower are low. It's more likely to trade up as long as it's a decent business. And Snapchat, well, it may not be as successful as some of the other social media platforms. It's a legitimate business, and it's not going away anytime soon. It's useful. People can use it to make calls. People can use it to sell products and services. They can keep in touch with each other. There's so many different uses for Snapchat or any social media platform, so it has some utility. They also have finances. You can look at their finances, and even though the finances aren't the greatest, it still has potential to grow in the future. So that's why I like a company that has some kind of fundamental support, which is what I just talked about. That's the fundamental side, and a technical side. It's been beat up on the chart. The chart just looks like it's ready for a bounce. That's when I'm talking about technical analysis, I'm basically saying just what people think might happen based on what the chart looks like, not what the company's doing, nothing about the company, just the chart. But I mix that with the fundamentals. So what else do we have here? It says, and it doesn't have any extra cost. If you're talking about the options, Yes, it does have a cost. You pay a premium to own those options. That's why I was saying earlier that people that sell options make money, because what you're doing when you buy an option is you're protecting yourself against risk. You're paying money to protect yourself against risk. But that also means that somebody has to sell you that option contract. So somebody is taking on that risk for you. So you're paying somebody else to take on your risk, which means if the stock goes up and you have a call option, the person that sold you that has to give you those 100 shares of that stock. So that means like you either have to own that stock and sell it, or you have to buy it at the price it is and give it to the person. That's why when people use option contract, they sell option contracts without owning the stock. That's risky because you don't know how high that could go and you could lose a ridiculous amount of money. But if you already own a stock, it's nice to sell call options on it because it allows you to collect income on shares that are just sitting there, which is what I like to do. That's why I want to have a long portfolio with a minimum of 200 shares of each investment, because I want to have 100 that I can sell. This is bare minimum. I'd like to have way more than this, but just for simplicity's sake, I'd like to have 100 that I sell options on and 100 that I don't, 100 that I keep no matter what. So that way I'm collecting that premium. So like I was saying before, somebody that buys a contract for $500 or whatever, the seller of that option gets to collect that $500. And if the stock doesn't move, that seller gets to keep all of that money. So it's actually really beneficial to sell options, and you're more likely to win because most contracts expire worthless. So buyers are usually the ones that lose out. Not always, but they can be. And that's why it's good to have the stock and sell options on it, so that way you cover your risk, which is what I like to do. I want to have the long portfolio, sell options on it, and keep it as the stock market goes up. That way, if you do get exercised and you have to sell those shares, you already have them and you're selling them at a profit. If you don't have the shares, you're getting screwed because you have to buy them at a huge deficit and give them to the other person. So, Snapchat, I like the way it looks. I was buying contracts in here. They're up quite a bit because Snapchat has had some restructuring lately. They had a nice pop on saying they're doing some layoffs. They laid off like 20% of their staff. They're canceling some of the projects they were working on because it costs a lot of money. And they're moving personnel onto new projects. So that's why Snapchat has been bouncing a little bit, because this whole drop happened for a reason. It's not because people just don't like Snapchat anymore. It's because there were fundamental reasons for this drop, and Snapchat is doing what they can to try to correct that. So that's why this was a great place to get those contracts. And I wish I purchased more, because if this thing flies again, right, there are going to be more earnings announcements, and this thing every so often it has a big move on an earnings announcement. And I have these contracts that last for about a year and a half. So in the next like 6 months, I'm going to have a couple of chances for that thing to pop off. And if it does, then I'm going to sell those for a profit and get out of them. That's what I'm thinking. So those are the trades that I made. I did, DocuSign, Kroger, Neo, Snapchat, and then I did another one on UVXY, which is a volatility product. There's something called the VIX, which tracks, it's just the fear index, to put it easily. It's how people are feeling about the market. When the index goes up, it means that people are afraid and the market is going down. When the index is down, it means the market is going up. So this is inverse to the market, and it's kind of a way to hedge if you know what you're doing. But UVXY is extremely risky. You could lose a whole bunch of money on this because it's guaranteed to go down over time. I'm not going to get into why because I've already gone on to too many tangents. But this is guaranteed to drop over time because of the way it's structured. So if you can make a quick trade on it, you can get one of these big pops. That's great. And that's what I was trying to do is when the market went down and UVXY went up right here, I shorted it because I expected it to go down. And look, it actually did. I dumped it before I really made anything on it. So that, because I was trying to do like an overnight thing that didn't actually work out. But that was my other trade. I got in somewhere in here and I let it out over here and I barely made anything on it. So that was the only other trade that I made. So now we can move on to the next stuff. All right. So getting into crypto, which will be the last thing before I go here. We had a couple of different pieces of news with crypto. The big one is the Ethereum merge from proof of work to proof of stake. What proof of work is it basically means how much machine power do you have. The faster your machines are, the more machines you have, the more money you're putting into the hardware, the more ability you have to mine these coins. So it's not as fair to the little person because somebody with a lot of money and resources can just dominate the mining market. They can have tons of rigs, faster rigs. That's how Bitcoin runs right now. That's how Ethereum runs right now. And a lot of cryptocurrencies have been running. However, there are other options. And one of the ones they're trying to move to is proof of stake, which is based on how much you have and how much you're willing to put up into the system. It's kind of a way to get you invested, get skin on the game. If you stake your currency, you're basically putting your currency up for a loan. You're loaning your currency out to something. So if you have an exchange that'll let you stake your currency, you stake it with that exchange, and then that exchange is doing whatever. It's either loaning it to people or it's using it for projects, but it's paying you interest to do that. It's exactly like a bank. You're loaning money in order to receive regular payments. So proof of stake is nice in that regard. So it also means that you don't need as much equipment, because right now it's proof of work is whoever works the hardest, whoever has the most equipment, which is terrible for the environment. And that's why it's being looked at. The whole reason that I'm bringing this up is not only because the Ethereum Merge, which we've been talking about for like 2 years or more. The other thing that's going on is the White House, they did a crypto report. And they say the industry should collaborate with environmental and energy regulators to develop clean standards. The thing is, though, if that fails, the report says Congress should, quote, consider legislation to limit or eliminate the use of high energy intensity consensus mechanisms, i.e. proof of work. So the more computers you have, the more you can mine, but the more energy you take and the harder that is on the environment. The energy used to mine that stuff in the United States is like equal to entire cities or entire states or something like that. It's ridiculous. So Ethereum is trying to go to hopefully a greener standard. I mean, there's still problems with it. It's not perfect, but it's something that will be less energy intensive. It'll cause you to put skin in the game, so you're actually invested and you're less likely to try to scam, which is what happens with these. Like, when the thing with proof of work is, if you're a smaller cryptocurrency, all someone needs to do to take you over is have 51% of the hash power. It's called a 51% attack. And there are other things like this, but just for simplicity's sake, we're going with the 51% attack thing. If you have enough power, you can take over a blockchain and you can say, no, none of these transactions are valid, and these ones that I say are valid are now the new way of being. So you can take over, just by having more power than anyone else, you can take over the blockchain and you can say, I own all the money. That's one problem. But with something like Bitcoin, it's such a massive undertaking that no individual entity really has the power to overtake the entire network. I mean, if some country like US or China decided to put all of its resources into doing it, yeah, they probably could. But would it be worth it? If you hack a currency, their value is going to crash. People are going to want to get out of it. So it's not really worth it to go crazy and do something like that. And also, you're going to have to spend a ridiculous amount of money to do it in the first place. So hopefully over time, these are going to improve. Now, is proof of stake perfect? No. There are plenty of problems with it. I'm not going to get into any of those. And I really do need to research that a little more. But I've read tons of stuff talking about the problems of proof of stake. Although in some ways, it does seem better than proof of work. I don't really know what the answer is in the long run, but that's what's going on right now. The regulation, that's what I wanted to bring up. So I'll finish that after I go to the comments here. So I still don't understand how crypto mining works. You fry your computer to get crypto. So the way I guess I'm gonna make this really like simple. Somebody might say it's not perfect, but basically what you're doing when you're mining crypto is you're taking a portion of your computer's processing power and you're solving a math equation first, right? It's a race to see who's going to solve the equation, and whoever solves it gets to mine the next little piece of Bitcoin or whatever cryptocurrency it is. So you're competing with everyone else to try to do a transaction, and that transaction is somebody bought something with your cryptocurrency. So let's say you go and you buy a basketball hoop with your cryptocurrency. You got Bitcoin. You're like, all right, I want that basketball hoop. You pay $200, $100, whatever it is for the basketball hoop. That transaction goes onto the blockchain and it sits in a queue waiting to be processed. And eventually, if your computer solves the math equation first, you get to process that transaction, which means you get to collect the fee from that transaction. So every time somebody buys something with a cryptocurrency, there's a little bit of a fee to basically pay for the energy it takes to do the transaction. It's exactly the same way credit card companies work, if you think about it. I mean, the technology is different, but credit cards are the same way. There's a massive, massive computer network set up to process transactions. When you use your Visa, there's a whole bunch of stuff involved in order to verify that transaction and move the money over. So Visa takes a cut, The store pays Visa just a little bit to do all that for it so that they don't have to and that they have access to that system. Crypto is the exact same way. You buy something, there's a fee for it, and computers are basically fighting for the right to collect that fee by processing that transaction. I hope that makes sense, but that's what you're doing when you're mining. You're trying to be the one that gets to process that transaction, and if you do, you get to collect the fee. So that's why people have all these computers dedicated to doing that, because they want to be the first one to solve the the math equation and then process the transaction to make the money on it. So that's how that works. Let me go back to the chat here. Okay, so you're mining for premiums, kind of. Yes. Well, like the transaction fee. Whose wallet does mine crypto come from? Yes, it makes sense to me. I didn't know it was about transactions. I think I understood. So it's not so much that it comes from a wallet. It's that money is created out of thin air. So it's exactly like the thing that people complain about with the monetary system. When you go into a bank and you put, you put $10,000 in the bank, 9,000 and 900 or 9,800 or something like that is able to be loaned out to somebody else. But that money that they loan out doesn't actually come from the 10,000 that you gave them. It's created. That's how money is printed. New money isn't like printed at the Fed and then sent out to the system. It's printed every time somebody goes and gets a loan. So that loan allows the money to be created and put into their account. And you have to keep a certain reserve amount, so you can't create another $10,000 out of that $10,000 deposit. You have to have more money in reserve than you create, because they're trying to at least to keep the system from collapsing if there's a run on the bank, right? Now, how much you're supposed to keep, that's changed over time, and to make more money, people have required less and less. But essentially, that's what you're doing, right? You're loaning out a piece of that. And cryptocurrency mining is very similar. So the protocols say that Bitcoin can only have 21 million Bitcoin in total by whenever the last one is mined, which will be like 100 years from now or something like that. Oh, I'm missing some stuff down here. Oh, so it's like the government printed payment. Oh, gotcha. Never could understand mining until now. Yeah, that makes sense. Yeah, so that's basically it. You're just processing the transaction, and because the Bitcoin protocol is already set up and it's running, that money is just created. It doesn't come from any specific wallet. The blockchain just gives it to you and puts it into your wallet, if you're the one that solves the equation and processes the transaction. So it's basically the exact same system we already have, but instead of being controlled by a central authority, it's controlled by individual nodes all over the world. So that's why it's called a decentralized system. It's meant to have a majority of people look at the transactions and the record, as opposed to a small minority holding on to everything. Like, they keep the records, they have the money, and everybody else has to go through that little bottleneck. Whereas with crypto, it's big enough to where it can be everywhere. However, it's still a young currency. Like, even though Bitcoin's kind of the OG and it's been around forever, it still is in its infancy compared to what it's going to be. So we'll see what happens with it over time, but that's essentially what's happening with mining. So you know what, I should be in the cryptocurrencies. I get on these rants and I don't have something on the screen that makes sense for it. So when you're watching them back, it's like, oh, I'm talking about Bitcoin and we've still got UVXY on the screen. But what we've seen with cryptocurrency lately is this little bounce and then kind of a retracement because of the market. So cryptocurrency seems to be forming a bottom, right? You can kind of use Bitcoin as proxy for the entire market because it is the biggest and everything trades based on it. If Bitcoin goes up, everything goes up, assuming it is not having some other problem. But for the most part, if Bitcoin goes up or down, other stuff goes up or down. And we've had this little bounce and retracement back to where there's a little bit of support because the market is waiting for the Fed event, and crypto is tied to the market. The other thing that people are thinking about is regulation, right? That's the big problem with cryptocurrency right now. What are governments going to do to regulate? If you think about the financial system, the fiat monetary system, it is regulated into oblivion. We've been using this thing for hundreds of years. Well, I mean, the modern system is only like 100 or a little over 100 years old. But essentially, we've had similar systems for a long time. We've been regulating and regulating and regulating to try to get things right. But cryptocurrency is still so new, we haven't had the time to have the problems necessary to regulate. Because like the reason we regulate things is because we have a problem. So we have some kind of problem, we regulate it, and then it either goes away or it changes and becomes something different. That's the problem with regulations. They're not always good. Like, sometimes they hurt things. And in the case of cryptocurrency, it could really, really hurt things. And that's what people are worried about. They're worried about the U.S. government saying, all right, we don't like cryptocurrency because it's a threat to our monetary system that we use to control the world, so we're going to make it illegal. If they did that, the price would tank. So people are worried about that, and they're keeping an eye out for it. And that's why there's been so much talk lately about this whole thing, right? So that's why I bring up the climate report, because cryptocurrency is extremely terrible on the environment. So energy regulators are like, hey, what do we do about this? And all the way up to the White House is looking at it saying, like, this is a problem. It's extremely popular. As time goes on with mining, that was the other thing I forgot to mention. The equation that you have to solve in order to do the transaction gets harder and harder. Like every time one is solved, the next one becomes harder and harder and harder. And it's designed to be like that so that the resource stays scarce. The problem with our monetary system is we can print indefinitely, which means we can keep companies alive that shouldn't be alive. Companies make terrible decisions. They have all the stupid debt they shouldn't have, and they are kept afloat because the Fed is able to just keep pumping money into them. The Fed's able to buy their bonds and give them money temporarily to hopefully fix their problems. And they never let the companies actually have their day of reckoning. They just keep propping them up and keep propping them up. These companies aren't adding value to the system, but they're being propped up by this monetary system. So I really lost my train of thought on where I was going with that. But the whole thing is, cryptocurrency could be regulated, and this whole climate thing, that was the part I didn't get to yet. So it says, so Congress said, consider legislation to limit or eliminate the use of high energy intensity consensus mechanisms. So a lot of cryptocurrencies either have to switch to something like proof of stake, or they're going to get crushed by the government. Now, this is all just talk at this point. This whole report was just to show the government what's been going on. Like, how bad is this energy problem? How bad is this whole crypto thing? It's just a report. But there's going to be a response to it at some point. If things continue to go up, so like I said, that equation gets tougher and tougher to solve, which means we're going to need more and more energy to solve that equation. That's not good for we're already looking at how to reduce our energy usage and look to more green alternatives, which are still being developed, but aren't there yet. So something that just takes more and more energy to not get any more value out of isn't something that's the best. So that is something to think about in the markets. I don't think they're going to do it. It's too much of a moneymaker right now, but it is possible that they could do something. So that's why I'm not super heavily invested in crypto. I own some outright. Like I made sure that I have a little bit of it. I sold a bunch on this, up here towards the top. Like I think the day before this actually started, I sold all my crypto. And I felt like a genius and thought when it bounced down in here to like the low 50s, it was right around here. I thought, all right, I'm going to start buying again. Well, you saw what happened. So even though I thought I was a genius for missing this little downtrend right here, I got all the rest of this. So I'm right in there with you. It's fun. I love it. I love that pain. But it's been beat up and it's finding a bottom. And if things switch over to things like proof of stake, if we continue to improve the energy usage of that and continue to improve the use case, more and more people use Bitcoin, use Ethereum for not just transactions, but whatever else they can be used for, that's going to be bullish for the sector and prop up the market. So I don't think it's dead yet, but we got to watch regulation. That's the big one. Hacks and regulation are the two biggest threats to crypto. Because right now, hacks are hitting them hard, too. Like bridges that allow cryptocurrencies to be exchanged to other cryptocurrencies. Like if you want to turn your Bitcoin into Ethereum or something like that, there are bridges that do that. But those bridges are extremely vulnerable. So hackers have been targeting those things and taking the money out of them. So there's still so much to do in this sector. But those were the two big things that I saw. The Ethereum merge is massive because we've been talking about that for years now. I've only been doing this show since like March. And, I think I've been talking about a little bit since then. But it's coming up in the next week or so. And the White House report saying they might do something if this energy thing isn't changed. So those are very important points to think about with the crypto market. So let me check chat real quick. Yeah, that makes sense. Anyone who can see the history of mined crypto. Interesting. All right. Yeah. So cryptocurrency is an interesting space. It's something like people are afraid of it. They hate it because this drop right there has gotten a lot of people out of it that were in it during the big pump up. But I love it. It's finally to a point where I don't feel so bad buying more. And like once it hit this level, I started buying more. Like I bought in here somewhere and then it did this kind of thing. And when it started to go down, I was like, all right, I'm not going to touch it for a while. And then it hit this big drop right here. And while it's going down here, like once it got into the 20s, that's when I started buying again. So I've been looking at little bits here and there, Bitcoin, Ethereum, altcoins, just trying to get whatever I can at a reasonable price, because if things continue to go down, which is likely, that's possible too. I don't want to be so exposed that I just get wiped out, right? Like cryptocurrency is powerful. Just owning a little bit could have been a lot. I mean, I owned a bunch when it was a bunch of Bitcoin, or like not just Bitcoin, a bunch of cryptocurrency when Bitcoin was at 3K. I sold most of it at 12K because I was a nice little run up, and I thought, hey, it's like 3-4x my gains. Yeah, I'm going to get out of this now. Well, I should have held because it went up to 60. Almost 70. Look at that, 69,355. So close to 70K. Man, I had like, I could have made so much money if I'd held. Anyway, so I'm liking that it's looking like that. The regulation thing is kind of a little kick in the pants to say, hey, you got to think about this, but it doesn't mean anything's going to happen yet. It's more hype in the market, and people are just kind of reacting to it. What we're really waiting for is the Fed. That's it. Let's see, between March and April. Are you talking about when I was buying or when things were looking better? Yeah, where's that? Is that the first of the year? Yeah, it already started to go down, and this was the beginning of the year, and it continued. That's right. Yeah, so around the beginning of the year, around March or April, when it really took off, that's when I stopped buying it. So I was kind of buying a little before that. Shouldn't all the candles overlap? This is a weekly chart, so no, it's not going to. It's just you're seeing a week's worth of time in each one of these, so you're going to see this kind of like, and also I'm zoomed out, so it looks like it's cluttered. But this whole area right here was crazy. It was up, down, up, down, up, down. People didn't know where it was going to go, which is why I kind of started buying in here, thinking that this was like the bottom because it was kind of flowing on a trend line, and there was a lot of consolidation. It just looked good, so that's what I was looking at it. I'm just confused why price would gap. Oh, because it trades 24/7 and you're wondering why would price gap? These are actually the futures. So these close, right? Bitcoin itself trades 24/7 on the exchanges that have it, and it can still gap if there's a huge order. Like let's say a millionaire comes in or a billionaire comes in and wants to buy like, $10 million worth of Bitcoin all of a sudden. That could gap up quickly if it hits all the orders that are sitting in the queue and then starts to get to the ones that are above that. So like a gap just basically means that a bunch of orders came in all at once, overwhelmed the sellers or the buyers, and then continued to move. Because you got to think most people are going to have their sell or buy orders placed close to where the price is at the time. So if you wipe all of those out, you get into less resistance and the thing can move a lot faster. So something that trades 24/7 can still gap if there's a big order that comes in one way or the other. Hopefully that makes sense. So that's why with the futures, they close on Friday and open on Sunday, like just like the rest of the market. So this will gap because there is a time where you can't trade these, right? I'm just using this as a proxy for the actual Bitcoin market because it follows the Bitcoin market when it's open. And it's just easier to do it on Thinkorswim instead of having to open up one of my other platforms that don't look as good on stream. Right. I like Thinkorswim because it's easy to pay attention to and it looks great on the stream. So, it's just a nice little platform, even if it is a little bit buggy. So cool. All right. So I got to wind things down here. We talked about a bunch, the big events that, like I said before, just to recap everything. We've got CPI on Tuesday, Consumer Price Index. That's going to tell us what inflation is looking like. Like I said, the estimates for the headline are going to be 8.5. That's the one you're going to see when you turn on, like some CNN, Fox News kind of stuff, and they start talking about inflation and how the world's going to blow up. They're talking about headline inflation, which includes everything, which basically means energy and food. The really extremely overpriced stuff right now, the really volatile markets, those are included in the headline inflation numbers. Now, the core CPI excludes those things. It takes into account everything else, but the stuff that moves a lot just isn't in there so that you can get a better picture of what the rest of the market looks like. If you only go by headline CPI, you could be fooled by the moves in energy and food because they move quite a bit. I mean, those are huge, huge markets. And you think like the Ukraine war made energy insanely expensive. It also messed with food because Ukraine and Russia export a ton of different commodities, wheat, corn, stuff like that. So the headline inflation is important to look at, but also core. So people are expecting, the estimates are around 8.5. If it comes in any lower than 8.5, that is bullish. That is what people are hoping for. Now, the farther down it goes, the better. So the problem with that will be, though, what is the market's reaction to that? If CPI comes in a lot better, which I don't think it's going to, my guess it's going to be somewhere around where it was last time, which is what the estimates are saying, that 8.5 area. I think that's a good estimate. It's probably, in my opinion, going to come around in there if I were to guess, because I honestly have no clue. I don't look at the economic data. I mean, I look at economic data, but I don't have the kind of data to know more than like the MBAs that are studying this stuff and putting all the numbers out now. So yeah, keep an eye on that. CPI 8.5 is the number to look at. If it's lower than that, that's bullish. If it's higher than that, that's bearish. Core, like I said, 5.9. That is important to pay attention to, but the market's going to react to the big number. So we're looking at headline. That's coming out on Tuesday. So be ready for that. So if you wake up on Tuesday and the market's already messed up, then that's what happened. The CPI numbers came out and it scared the market, or the CPI numbers came out and it popped the market. Those usually come out, I think 5-ish in the morning Pacific time, like 5:30, and the market for me opens at 6:30. So those numbers will cause a whole bunch of movement in pre-market. So if you notice on Tuesday, things look really crazy. That's why. So we're waiting for that because that's going to be a big influence on the Fed. The next one I'm looking at is retail sales numbers. I'm not really that one doesn't matter as much to me. That's just kind of a way to gauge the health of retail companies right now. It's good to look at. So retail sales, business inventories is another one that tells you how much stock is sitting around. Like how much of this stuff do people have to get rid of, because we have a glut right now. When the shipping crisis happened and everything was backed up, stores ordered way too much merchandise. It took too long to get there, so it was out of style, which means they couldn't sell it at the same price. So they basically took a loss on merchandise before it even hit the floor of their stores, and now they have to get rid of it. So the business inventories will kind of help with that. It'll be like, all right, how are these inventories doing since we had that problem? Because we've had that problem for a while now, and it hopefully will start to clean up at this point. So I'm paying attention to those a little bit, but more so on the CPI. The last thing besides the Ethereum merger is the Fed meeting, the FOMC meeting on Wednesday, the 21st. I'm trimming my position to have cash for the event, getting ready for a possible Fed bounce. Afterwards, I don't know if I'm going to stay long on that bounce. I might take some gains if it goes for a while, because I don't know how long to wait, to be honest with you. I mean, we've had bounces that last for 3 weeks. We've had bounces that last for a day. We've had bounces that last for a week. So I really don't know what it's going to do, but I want to make sure that I'm ready to jump on whatever it does. So those are the things we're looking at: CPI, Ethereum merge, and the FOMC meeting, trying to get into cash. That's really all we're waiting for. I mean, the market wants to do that. The market wants to know what's going on with the Fed, and the Fed wants to know what's going on with the economy. So we got this big chain to go through. That's pretty much it. I think I've gone through everything I wanted to say. I need to get out of here. I've got a barbecue to go to pretty soon. Thanks for staying with me. I'm a Stockalypse. I do this every other Sunday at 3 p.m. Pacific. I mostly discuss stocks, options, and cryptos, as well as whatever chat wants to bring up. I really appreciate all of you taking the time out of your weekend to hang out with me on Sunday Night Finance. Like I said, the big event is the Fed, and I'm trimming whatever I can to have as much cash as possible. So that's the strategy right now. As long as positions could benefit from a squeeze, then I'm ready to do that. So enjoy the rest of your weekend. Be safe. Thanks for hanging with me, and let's make some money. All right. Good night.